Moves are a bit of a head fake. He sees more negative pressure.
Yeah, that's right. Although there are people out there who are bullish as well. So there's two sides of the coin. That's what makes a market. You can see futures here are up, and FTSE futures, which are down, have now turned higher. This as Asian stocks pretty much across the board put up some gains after new records, especially for tech stocks in the U.S. yesterday. Take a look as the live cash open kicks off at our global macro movers screen. Here you can see different risk assets in each column. On your far left column, you see equity indexes opening up, and the FTSE is swinging back and forth between gains and losses, but the CAC 40 opens up 0.6% higher. The Euro Stoxx is 0.5% higher. The IBEX 35 in Madrid is 0.4% higher. So in general, European stocks are opening higher while the FTSE fails to really find direction in the first seconds and minutes of trade. But global equities are closing in on levels that we last saw, high levels that we last saw in February. U.S. stocks got a boost on the news that the White House is exploring whether President Donald Trump can act on his own to extend enhanced unemployment benefits. A manufacturing expansion in July also helping to boost indexes, and slowed infections in several states didn't hurt either. Joining us is Hugh Gimber, JP Morgan Asset Management Global Market Strategist. Hugh, is now the time, is it still time to be risk on? Are there legs left in these rallies?
I think it's still the time to be invested, because the trouble with investing at the moment is that if you want to go and hide, there are very few places to do so. Your alternatives, such as core government bond markets, are offering very little. And I think that, for me, is the strongest support for risk assets at the moment. That you look across the investment landscape, and really, whilst equities and credit do look relatively expensive compared to history, they don't look as expensive as the core government bond markets. And so we do still see some scope for risk assets to grind out reasonable returns through the second half of the year. But I think this is one where investors do broadly accept that the pace of gains that we saw for much of Q2 are unlikely to continue from these kinds of starting levels.
But Hugh, what about the risk, especially the near-term risk? We have the U.S. election in November. We still don't have a fiscal package out of D.C., and we have really brewing tensions between China and the United States. Some are saying that's going to lead to this bifurcated tech space and supply chains. What risk do you see to this positive outlook you have?
Of course. So I think those are the right ones. For me, the U.S.-China relationship is heading down a tricky path, but that's really been the story for the past couple of years. I think investors are now quite used to the idea that these two superpowers are going head-to-head. And frankly, the news that we've seen over the past few months, I think from a macroeconomic perspective, has been less worrying, because it tended to be the tariff escalation that have had more of an impact on macro data, thinking about business confidence, corporate investment intentions, for example. And so on that part of the story, I think, yes, there is a risk that markets are unsettled by escalating hostilities, but really that hasn't changed for the past couple of years, and I don't think it will really change for the next couple of years. Similar story for me with the US election, that on many of the key policy aspects running into November, both the Democrats and the Republicans look relatively well aligned. And so you take regulation towards big tech as an example there, and I think, again, investors can understand that the direction of travel is going to be tougher towards these big tech names. And so you're absolutely right with the risks that you highlight. And I think, this isn't a time to be overly bulled up, but we still see pockets of opportunity, particularly in those markets that have the really strong support from policymakers, such as investment grade and high yield credit at this point.
I wonder what you think about, the rule of law is important to investors, and it could be concerning if countries just start saying, XYZ company is a security threat, so we demand it be sold, and the buyer needs to also give us a percentage, give us a big payoff in that sale as well. I mean, does this worry you about investing in the U.S.?
Not personally, no. I think clearly there are many sort of political agendas at play here, but broadly, when you're looking at the US market, you're still looking at names that have really strong balance sheets and often very diversified earning streams. So for me, when you're picking through at a company-by-company basis, you want to be thinking about the ability for a corporate to grow, not just through M&A activity. We know that for these mega cap names, that is going to get tougher regardless of where you're looking around the world or which mega cap name you're assessing. But if you can demonstrate that you're confident that the ability for that corporate to grow sustainably over the next, let's say, 3 to 5 years is there, because they still have ways of getting to higher revenues ahead that aren't just reliant on buying that growth, then I still think there are decent opportunities ahead. Clearly, the political landscape is a very complicated one, but that for me is not enough of a reason at this stage to be sitting on the sidelines waiting for clearer times. Because, life has been complicated for the past few years, and I suspect it will continue to be so.
Hugh, this morning what we're looking at as well and trying to digest was, of course, yesterday's massive tech rally, and we wanted to know, for our MLive question of the day, the markets team questions, is the next 10% for the NASDAQ higher or lower? In your opinion, where do you see it?
Sure. So I think when we look at why the NASDAQ has rallied so hard, it's because there have been themes this year that have really been accelerated by the type of recession that we're looking at. And so the shift to online retail being a very good example, and one which I think is now broadly understood by the market. And so when I think about investing within tech, I still think that there are decent opportunities to play those types of themes. But perhaps now, when you're looking at some pretty elevated valuations and some pretty challenging earnings estimates to meet in the quarters to come, there are cheaper ways to play that theme than focusing on the pure kind of headline favorite NASDAQ names. And so I think the NASDAQ from here, it's hard to say when you're at all-time highs that, yes, clearly there's 10% upside given what is already in the price today. But I do think that the themes that have been driving those tech winners to this point can continue. It's maybe just looking at more sophisticated and slightly more nuanced ways of playing those same trends.
All right, Hugh, we're going to keep you with us for more. Hugh Gimber is JP Morgan Asset Management Global Market Strategist. We got more to discuss with him in these markets. Coming up, Alphabet's big sale. Google's owner is auctioning $10 billion of ESG debt at rock-bottom yields as the credit risk in Europe falls to the lowest since February. We'll talk opportunities in the credit space next. This is Bloomberg. Welcome back to the European Open. We are 10 minutes into the trading day, and you can see we have green arrows across European equity indexes, specifically on the continent here. The DAX up 0.6%, the CAC Quarante gaining 0.7%, while the FTSE just rises a bit. Let's get the Bloomberg Business Flash right now. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. BP has cut its dividend for the first time in a decade. It was widely expected after Shell made a similar move, but it was unthinkable before this year. Big Oil's generous payouts have long been one of its main attractions to investors. BP reported an adjusted loss of nearly $6.7 billion, but not as bad as expected. Bayer says the pandemic has hurt demand for some of its medicines, hitting its outlook for the year. The slowdown in non-essential medical procedures hurt Bayer's pharma division. Its consumer health unit got a boost earlier this year from people stockpiling over-the-counter medicines, but that effect waned in the second quarter. Twitter is being investigated by the Federal Trade Commission for alleged privacy violations. It's another setback for the company that struggled in recent years to protect user data and account security. The FTC is probing the use of phone numbers uploaded for security purposes to target people with advertising. That's your Bloomberg Business Flash. Anne-Marie, Matt.
Laura Wright in London, thank you so much. Now, tech companies are in the business of breaking records. In a rare sale, Alphabet has sold $10 billion of bonds with the lowest yields yet seen for corporate debt. The 7-year portion was auctioned at 0.8%, while 40-year debt has a 2.25% yield. It was also the largest corporate bond sale dedicated to ESG, with more than half of the total allocated to environmental, social, and governance purposes. Hugh Gimber is back with us. He's JP Morgan Asset Management Global Market Strategist. Let's start quickly with this, what Alphabet has announced. Will this open the floodgates, do you think, Hugh?
I think the floodgates have been open for some time, really, that corporates have been tapping into very strong credit markets through much of Q2 and into July and August, because simply financing has been very cheap to access. Since the Fed's announcement at the end of March that they would provide that backstop to credit markets, both in IG and in high yield, I think the question for corporates really for much of this has been, well, why not go and access some extra funds and strengthen balance sheets in a period where the economic outlook is still highly uncertain, and therefore why not just simply absorb a slightly bigger cash buffer in case it becomes necessary to use that further down the line. And so Google is clearly at the extremes of that in terms of tapping in at record levels. But I think this is a continuation of a trend that's been in play for some time and has really been supported by that strong demand for yield, the hunt for income, investors looking outside of the government bond space and tapping into credit to try and find anything with a marginally higher coupon.
Do you expect to see defaults climb? We've already seen, I think, 190 bankruptcies in the U.S. year to date. Is that going to be a problem here as well in Q3 and Q4, more than it has been in the first half?
I think the direction of travel for defaults has to be higher, yes, but I think at a relatively gradual pace. And really what we've seen from Google is a good example of why, because corporates are able at the moment to roll over their financing relatively easily. And so if anything, there are problems, but they're likely to be further down the line. I think the sort of cash flow hurdles for corporates through the rest of this year look relatively manageable. And therefore, I think that you're still getting decent compensation. It's a similar story to the equity market, really, that you can't continue to see the same amount of spread tightening that we had in Q2. But for me, I would expect credit spreads as a base case to be grinding moderately tighter through the second half of this year, just given the technicals in the market at the moment. That even with massive amounts of supply, the demand is so strong that that is being very well absorbed and that credit spreads look pretty well supported from here.
Hugh, you also like the energy sector, specifically high yield. I want to know, because we have BP reporting today, what names are you interested in?
Sure. So I'd say I like the high yield sector probably more than I do the energy sector. For me, energy within high yield is still one of the most challenging parts of the market. because I think you're still trying to properly understand which are going to be the companies that are able to sustainably manage with lower oil prices ahead. I think it is broadly understood that we're not going back to $70, $80, $90 a barrel for oil in a world where demand is taking some time to recover. And frankly, I think that demand for oil over the next 5 years is clearly going to be lower than it has been over the past 5 years. So within high yield, I think you stay away from the energy sector if you can. And if you do go into the energy sector, you need to be very careful about picking through the names which have effectively balance sheets that are strong enough and business models that are strong enough to cope with oil prices around current levels, because I think the outlook from here is pretty tough to see oil prices moving that much higher.
I want to ask you about sovereigns, Hugh. If I go on my WB page on the Bloomberg and screen through all of the European 10-year maturities, I don't see any that's yielding more than 1%, bar Greece. I mean, even Italy is yielding less than 1% right now. Do you think investors can still find some capital gains in these peripheral issues?
I suspect that much of those gains have already been made now. I think that the news around, particularly in Europe, this positive story around the periphery is pretty well reflected in the price. And so I think, again, you're having to look very carefully within government bond markets to find opportunities today and spread the net wider. So Chinese government bonds being an area that have done particularly well this year, and an area that I think for many investors would not have traditionally been part of a core government bond portfolio. So within rates, you're having to look harder. And I think when I speak to multi-asset investors as well, they're thinking about not just allocating from government bonds into equities, but thinking about assets that can replace some of the qualities that government bonds have traditionally offered in a portfolio. Because I do still see a small amount of room for yields to move lower if we do get a risk-off scenario in the second half, but I don't think there's very much more. And so investors, I think, are primarily focused today on hunting for alternative forms of diversification and alternative forms of income. So that explains the really strong demand that we've seen across the industry for areas such as infrastructure and real estate, trying to offer some of that income that government bonds have historically provided, which clearly won't be there going forward.
All right, Hugh, thanks very much for joining us this morning. A lot of insight from you today that I think investors are going to find very useful. JP Morgan Asset Management Global Market Strategist Hugh Gimber. He's going to continue the conversation with us on Bloomberg Radio as well at 9 a.m. UK time. So if you're in the city, you can tune in on London DAB. Otherwise, you can just Google it. Or if you can figure out radioplayer.co.uk, that may be an option as well. Coming up, Commerzbank deals a blow to its second biggest shareholder with its pick for chairman. We're going to give you those details next. This is Bloomberg.
Welcome back to the European Open. We're 21 minutes into today's trading session. FTSE 100 relatively flat, but we are seeing gains across the DAX and the CAC. Now on Wall Street, being black often means being alone, held back, and deprived of the best opportunities. We're putting the spotlight on diversity to see how things could be better. Zenelia Harris, president of Harris & Harris Wealth Management, spoke to Bloomberg TV about the realities of Wall Street inequality.
I do think that there's an opportunity for Wall Street to embrace diversity for sure. And one of the reasons why I think that there's room for growth is because as you highlighted in the article, so many of us have gone there with the hopes of achieving success to then deal with the harsh reality of not being able to reach the levels that we've seen our white counterparts reach. And that has been disheartening for me because I wanted to succeed. You know, when I came out of college, my goal was to achieve the American dream.
That was Zenelia Harris, president of Harris & Harris Wealth Management. And you can catch more of our coverage and our interviews in the latest issue of the Market magazine. It's a special edition out now that's taking a closer look into diversity. And I really suggest you go get your hands on this, Matt.
Yeah, absolutely. All right, Commerzbank dealt a blow to its second biggest shareholder, Cerberus Capital Management, by appointing Hans-Jörg Vetter as supervisory board chairman. The New York-based private equity firm had tried to block the move. Joining us now is Bloomberg's German banks reporter, Stephen Ahrens in Frankfurt. So, Stephen, how big of a, brouhaha was this? Why wasn't the Cerberus, which I always find it amusing that it's named after the three-headed dog that guards the gates of hell. Why wasn't Cerberus able to block Vetter?
Hi, Matt. So yeah, it's a good question, and they did oppose Vetter's appointment very vehemently. They sent a letter to the supervisory board saying he's not the right guy for the job. We got other candidates. Don't appoint him. And the Commerzbank supervisory board just overruled Cerberus. They just told them, we don't care about your opinion, essentially. And that is bad for Cerberus. It makes him look bad, but it's also bad for the new chairman because he now faces a big and very active investor who clearly doesn't like him.
Stephen, it's Emery here in London. So what is the future going to look like under him?
Well, the short-term future is to find a new CEO. The current CEO is still there, Martin Sielke, but he said last month he wants to step down by the end of the year or when they've identified a successor. So that's happening, and that's going to be the foremost task for the new chairman now, to find someone to lead the bank. And then, of course, the bank is in desperate need for a very, very deep restructuring, for a very deep new round of cost cutting that the new CEO will need to initiate. The sitting CEO had plans to cut the workforce by a quarter and make various other deep cuts. It's likely the new CEO will intensify those cuts even, and so the bank is in store for a very deep change, and they will need a CEO who can push those changes through.
Bloomberg's German banks reporter Stephen Ahrens, thanks so much for joining us this morning. We're going to take a look at quickly what's going on with your movers this morning. BP, that stock is higher. This comes even after they cut the dividend. First time in a decade since the Deepwater Horizon disaster. The stock is up more than 5%. But of course, their loss was less than expected, and that dividend cut was likely priced in. And then Bayer to the downside, down more than 3%. They said that their pandemic has really hurt demand for some of its medicines, and that put pressure on the stock. And then Diageo, it's the biggest loser this morning on the stock 600 after earnings were hit bad by closed bars and restaurants. They missed estimates, and they still have no guidance for next year. Matt, interestingly, though, the CEO told us e-commerce is small, but it's growing.
Yeah, I think that's really a fascinating avenue for beverage makers to sell alcohol. I know in the U.S. It's very difficult because you've got so many laws about how old you need to be before you can buy alcohol. But in other countries, it's not quite as hard. Coming up, remote IT access firm TViewer reports a bounce in its second quarter earnings as it benefits from the rise of home working during the pandemic lockdowns. We speak to the CEO, Oliver Steil, next. This is Bloomberg.
Welcome back to the European Open. I'm Anne-Marie Hordern alongside Matt Miller in Berlin. We're 30 minutes into the European market trading. Let's take a look at what's going on. The Stock 600, we reversed the early gains we saw out of the gate. We are now a little bit to the downside this morning. We've had everything today in terms of earnings, and we can see the virus is hitting dividends, drinks, drugs, semiconductors. And that's where I want to take you to the story today, and that's in the sector picture. And the sector picture really shows what's going on in the underlying movers this morning. Oil and gas is the biggest gainer. BP is doing well today, even though they cut the dividend for the first time in a decade since the Deepwater Horizon disaster. A lot of this was priced in, and their loss wasn't as big as expected. But then if you look at what's dragging down the index, it's food and beverage. And of course, we had Diageo. They missed estimates. They didn't give guidance. They are really hit hard by the closing of restaurants and bars for some of their products like Casamigos and Don Julio Tequila. Now, let's get to the Bloomberg First Word News with Laura Wright. Laura, good morning.
Thanks, Anne-Marie. TikTok has to sell its US arm by September 15th or close. That's according to President Donald Trump. He says he does not mind who buys it, Microsoft or another firm, as long as it's a big, secure American company. The president also says any sale would have to include a substantial payment to the US government. The Bank of England may be undermining the UK's push for a green recovery. That's the finding of the think tank, the New Economics Foundation. Its report says the central bank is effectively subsidising polluting industries with its pandemic rescue programme. It says large amounts of money have been pumped into the dirtiest sectors, despite being smaller parts of the UK economy. Argentina is moving closer to an agreement to restructure $65 billion of debt. The nation's bonds rallied on the news, which comes after months of talks. The fine points of the deal between Argentina and its creditors are still under discussion. It would mark a first step towards stabilizing the struggling economy, poised for its third straight year of recession. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anne-Marie. Matt.
Laura, thanks very much. Laura right there with your first word news. Now, TeamViewer has been a pandemic success story. The German firm makes tools for remote access to computers and has been a big winner from the rise of working from home. It's reported a bounce in its second quarter revenue, but there is uncertainty if that success can continue. The stock is down a little bit this morning. Joining us now to talk about the company's latest blockbuster earnings is TeamViewer's CEO, Oliver Steil. Oliver, thanks very much for joining us. I guess the most important question for investors is how sticky your success, your progress can be, and what kind of future are we looking at in terms of the working from home phenomenon?
Yeah, I think the pandemic has shown that companies really need to prepare for remote working in a broader sense. So not just office workers working from home through video conference, but also making sure that many other tasks across functions in a company can be performed from different places remotely. And that's where our solutions come into play. So we connect devices, we connect machines, we connect to the back-end systems, and therefore many more tasks by workers can now be performed from different places. And I think that's what companies need to prepare for. And that makes our solution very sticky from our perspective.
What about with more and more people returning to work? You have obviously probably a lot of new customers with people stuck at home. Do you think that you're going to be continue to keep on and hold on to these new customers?
Yeah, that's what we see. I think the common understanding is that a lot of these new processes, remote working processes, will stay. I think companies are adjusting to the new norm. I think new business processes are emerging and have been emerging faster than before. I think digitalization was around already before, across all verticals and across all industries, but now really it has gotten an extra push, and companies want to be prepared, and they want to keep some of the good things that they learned during the pandemic crisis, and therefore we believe it will stay, and that's also what we're seeing in our numbers.
I wonder about M&A. It's been lackluster overall during this pandemic, but it looks like people are beginning to find opportunities. You had previously found Ubimax. Do you think that there's more M&A to be done for TeamViewer this year, or can you find an opportunity here and take advantage of it?
Yeah, so certainly we believe that we have a very strong organic growth strategy, but also if there are technology companies which serve the enterprise segment in the areas we were just discussing around digitalization of business processes, that's attractive for us, that's interesting. And of course we keep our eyes open. We look at companies. Ubimax is a perfect example. It serves the enterprise segment in core business processes. It allows for digitalization solutions using latest AR technology. So very interesting technology field where we added significant technology competence and reach to customers. And those type of companies will be attractive. Of course, we look around. We will see whether there are opportunities, whether it's this year or next year. That remains to be seen. Of course, it's also a factor of the overall economic development and the development throughout the year for us as a company, but also for the economic overall.
Are there regions, Oliver, that you think TeamViewer could be stronger in, or are there areas in the business where you want to add competency?
Yeah, I think the key areas which we like a lot is digitalization in the industrial environment and in the service environment. So everything which has to do with IoT, artificial intelligence, data analytics, connectivity of very different type of machinery to allow for collaboration between doctor, patients, service technicians, and the like, support of things. So these areas are very attractive for us, and we develop our own product. We innovate into these areas, but we also have an open look at companies. Regionally, to your question, clearly APAC is a growth region. We opened offices in India, Japan, China over the last 2 years, and we doubled down on this. And our fastest growing region has been for quite some time now the Americas, specifically US and Canada. We're also doubling down on this. So we are on a, I would say, global rollout with our solutions and our products, and we want to deepen our technology competence.
Oliver, you were, prior to this job, a partner at an international private equity firm. What does the current landscape look for sponsors?
So it's a bit ago, I have to say, almost 3 years now. But I think there is probably, the way I see it, there is opportunities which are coming up. I think the financing markets look pretty good in some regions at least. And of course, due to the pandemic, there is companies which are available for transactions, maybe more than before. And I think that's fundamentally an attractive environment. But of course, there's lots of uncertainty also with the second wave of the pandemic across regions. So it's probably not such an easy play, but there's opportunities from our perspective.
How closely are you following, the virus uptick? I noticed the last few days here in Germany, we were adding, again, almost 1,000 cases in each 24-hour period. Are you worried about a second wave?
We follow that very closely because we have offices around the globe. So as much as we work now in the German headquarters, we work on a rotational basis, 30 to 50%, depending on our teams in the office. In other markets, for example, US, Tampa, we're still working all from home. The same in Mumbai, India, and and I think Australia, we watch carefully. Our office is in Adelaide, not very affected at the moment, but of course we see the pandemic there. So yes, we are concerned, clearly. The numbers are increasing, and of course with the holiday season, I think we all see the pictures of people being very, very close to each other, and that puts quite some question marks about the time when people return from vacation and are back in their home country. So yes, worried.
All right, Oliver, thanks so much for joining us. Oliver Steil there from TeamViewer talking to us about the business and opportunities. Great to have some time with you. Hope to get you back again soon. Up next, President Trump said TikTok will have to close its U.S. business by September 15th. Unless there's a deal to sell the social media network's American operations, and if there is, he wants the federal government to get a big payment as a result as well. We'll look into that story next. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 42 minutes into the trading day right now, and we're seeing gains in European equity indexes. The FTSE right now kind of hovering back and forth between gains and losses, currently down a little, but we do see the DAX gaining 0.2% and the CAC 40 in Paris up 0.6%. Let's get the Bloomberg Business Flash news now. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Commerzbank has appointed Hans-Jörg Vetter as its supervisory board chairman. It's a blow to its second biggest shareholder, Cerberus, which tried to block the move. The private equity firm launched a campaign in June to change the lender's strategy. It resulted in the exits of the bank's chairman and CEO. U.S. aviation regulators have proposed a long list of fixes for Boeing's grounded 737 MAX. It's one of the most extensive set of requirements the agency has ever issued following an accident. The release by the Federal Aviation Administration is a major step in getting the 737 MAX back into the air. Alphabet has sold $5.75 billion of bonds, the largest ever corporate bond sale dedicated to environmental, social, and governance purposes. The company is looking to fund organizations that support Black entrepreneurs and businesses impacted by COVID-19. The borrowing can also be used to finance clean energy projects and green buildings. That's your Bloomberg Business Flash. Matt, Anne-Marie.
Laura Wright in London, thanks so much. Now, President Trump's latest assault on TikTok has opened a new front in the trade war with China. It may see restrictions on tech companies that could potentially have enormous ramifications for the world's biggest economies. The president says TikTok must sell its U.S. operations by September 15th or close down, and has insisted that any deal would have to include a substantial payout to the U.S., though it is unclear under what authority.
The United States should get a very large percentage of that price because we're making it possible. Without us, I use the expression, it's like the landlord and the tenant. And without the lease, the tenant doesn't have the value. Well, we're sort of, in a certain way, the lease. We make it possible to have this great success.
Joining us now is Bloomberg Senior International Editor in Hong Kong, Jody Schneider. Jody, thanks so much for joining us and good morning. What could complicate Microsoft's potential deal with TikTok?
Yeah, well, one thing that could certainly complicate it is the Chinese government, according to an editorial in the state-run China Daily today, said that they won't necessarily accept an acquisition of TikTok's U.S. operations by Microsoft and may take action against Washington if such a sale is forced. So obviously that would be a very large hurdle to trying to do this deal. The other thing is trying to do it by September 15th, a date that President Trump has said this deal needs to be done by, or else he may ban TikTok in the U.S. That's a tough deal to get done in essentially a little less than a month and a half, especially given the international nature of it and given that Microsoft has said they are trying to satisfy all parties in such a deal. It wouldn't only be to sell, to buy the U.S. business, it would also be to buy it in Canada, Australia, and New Zealand. So it's a complicated deal to start with.
The interesting thing, the whole thing is complicated for a lot of people to understand. The U.S. now saying this company, because of security concerns, can't operate there, and that maybe that'll be make it easier for a local competitor to buy it on the cheap, already raising eyebrows. But now President Trump is saying the U.S. should be getting a payment as well. So what, if Microsoft buys TikTok, then it has to also send a payment to Washington?
Well, it's really unclear under what authority President Trump could extract such a payment. First of all, it would be unprecedented for the U.S. government to collect a cut of a transaction that involving companies in which it doesn't hold a stake, and it doesn't in this case. President Trump has said the money would come from China or an American buyer, like presumably Microsoft. But it's unclear how that could all work. We have never really seen that. He claims that this is he could get this deal because he has essentially brokered it using his language about landlord-tenant dynamics. but because he brokered it because he said he would ban it if it wasn't purchased. So it's really unclear that any of that could happen, and whether it would be legal in the first place. And certainly now with China coming out and saying they wouldn't necessarily accept an acquisition of TikTok U.S. operations by Microsoft anyways. So it's all complicated. Microsoft, for its part, seems to be going along trying to do this deal, but every day we get kind of a different situation with this. Friday, it looked like TikTok was going to be banned in the U.S. Then over the weekend, Microsoft was talking to the president, and they said by September 15th. Today, we hear about this payment the president wants. Who knows what we'll see tomorrow? It is really kind of just this unfolding situation. Meanwhile, plenty of people in the U.S. are upset that they may lose their TikTok. It's very popular. Not only it started off being popular with teenagers, now it's popular with a whole range of people.
Yeah, it seems more and more people are signing up. Definitely, I think, started more so Generation Z. I still don't have one. I feel like I need to check it out, given we talk about it almost any day. As you say, Jody, there are complications, but you laid out a lot of the geopolitical risk. What about the implications in this fight for the internet? I mean, Matt and I have been talking about all week about, are we going towards this bifurcation of the tech world of East versus West?
Well, that's right. There's broader implications here than just this particular deal. The U.S. is expanding this fight against Beijing using essentially Chinese-style restrictions on tech companies. It could have enormous ramifications and could, in some ways, backfire on the U.S. as well. At the same time that they're going ahead and trying to do this, Secretary of State Mike Pompeo is saying that they're going to continue this pressure campaign to ban Huawei and to try to get allies to ban Huawei. So there's a lot of things going on this front, but it really is expanding this technological fight as well as, obviously, this growing geopolitical fight between the two countries.
Well, and Jody, you have to wonder how far it could go, not just East versus West, but what if Brussels decided that Google was a security threat and then forced a sale of its European operations to, say, SAP? I mean, if you start to, confiscate businesses because they're security threats and then force their sale to your own domestic competitors, it creates real problems globally.
Well, that's right. And it's unclear where the U.S. would draw the line. I mean, if they're saying, okay, Huawei is one thing, TikTok's another thing, how far down that road can you go? What do you consider a national security risk? Under what, auspices are you deciding that? And, of course, then there's the other side of it. Then China can be, they are known to have, and they make it very clear that they will take retribution for each step that the U.S. does. And then, as you raise, what about European countries? What if they decide that there could be some security risks for them as well? Then you get into this kind of global technological battle. And frankly, at the same time, you don't see 5G being expanded because everybody's trying to wall up their technology.
Well, we have a 2-month visa.
All right, Jody, thanks very much. Jody Schneider there, Bloomberg Senior International Editor, coming to us out of Hong Kong. Up next is the next 10% for the NASDAQ. A higher move or a lower move? We're going to put that question to Christine Aquino, who leads our MLive team in Europe. This is Bloomberg.
Domestic, the Federal Reserve's and yet that doesn't inflation preference there to tie forward guidance to
Time, you're seeing shut-ins. I mean, people who are particularly if they're in person, they collapse. So you're going to have
Welcome back to the European Open. We're 53 minutes in today's trading session, and we are off the highs of the day. The FTSE 100 is now down nearly 0.5% alongside the DAX, with the CAC and RON eking out a bit of gains. Joining us now is Christine Aquino, who leads our MLive team in Europe. Christine, I want to start out with TikTok. We just spoke to Jody about this, about the political implications, but we're not seeing much reaction in the market. What do you make of these brewing tensions between Beijing and Washington?
Yeah, it's very interesting, Emery, that we really haven't seen any spillover into the tech sector or much of the other parts of the market. And I think that speaks to how, I think for investors, this is still a very nebulous concept. You know, the concept of U.S. banning Chinese companies or maybe trying to circumvent it and find a way to get some revenue income from them. It's all very hard for markets to comprehend at the moment. And that's why I think they're shrugging it off and dismissing it as a theoretical risk rather than something that they have to face imminently. And if nothing else, I think this is increasing the attention on TikTok specifically, but also on Chinese tech companies in general. It's very interesting to see, for instance, grown men and women defending TikTok which is essentially it's a dance app for Zoomers, is what I know it as from my very little knowledge of it. But it's very interesting to see that. And if nothing else, I think this would work out to increasing the attention on this particular sector and Chinese tech, which is, as we know, a growing sector.
I guess then the concern is that the Chinese state would then steal Generation Z's dance moves, which I can understand, you know, the severity, the seriousness of that. Let me ask you about the MLive question of the day. Is the next move for the NASDAQ, is the next 10% move going to be higher or lower? What are you hearing?
Well, so far, Matt, the verdict that we've gotten is decidedly higher. And again, that speaks to the exuberance in the sector that it can shrug off risks like the TikTok conversation and others. And it also really speaks to how tech has taken on the mantle of being the gauge of animal spirits in markets and in the economy. And, you know, we've spoken a lot about the merits of valuations and how tech in particular is looking particularly overheated on that front, but it really seems to matter little for investors who have apparently a lot of exuberance and are looking for avenues to express that. And you know, it does have the sense of the tech world being a little bit disconnected from the quote unquote reality of valuations and those being a little bit high. But it also does speak to the idea that investors in the sector are looking at more than that and valuing these companies beyond what we can see for B&Es.
Christine, we're going to have to leave it there. Christine Aquino, who leads our MLive team, and sources close to the matter tell me she actually does have a TikTok. Stay with us. This is Bloomberg.
Ticking clock, President Trump says TikTok must close its U.S. operations by September 15th unless it is sold. He insists any sale must include a substantial payment to the U.S. government. BP cuts its dividend for the first time since the Gulf oil spill, but the oil giant's loss is narrower than expected. And sales slump at Diageo. Closures of bars and restaurants weigh on the drink maker. We'll hear from the company's chief executive. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. This is what the markets are doing. A lot of focus, of course, is on oil. A lot of the focus is on what we heard from BP. So let's bring in the data check for you to have a look at. European stocks are really fluctuating, failing to carry forward the momentum that we saw from Asia, but also from Wall Street yesterday. Yesterday, we had a technology-fueled rally, which got support from positive economic data. They also got support from potential further stimulus. Today, things seem to be going a bit sideways. Treasuries maintaining some of the losses. You can see European stocks down some 0.5%. Now let's get straight to the Bloomberg First Word News. Here in London is Laura Wright. Hi, Laura.
Thanks, Francine. TikTok has to sell its U.S. arm by September 15th or close. That's according to President Donald Trump. He says he does not mind who buys it, Microsoft or another firm, as long as it's a big, secure American company. The president also says any sale would have to include a substantial payment to the U.S. government. In Australia, Victoria is imposing a fine for anyone flouting isolation rules. It's the latest policy to battle a spike in coronavirus cases. On-the-spot fines could be around $3,500 US. Repeat offenders may see a court penalty of 4 times as much. Victoria has imposed a curfew on the city of Melbourne and a statewide lockdown. Spain's former king is planning to leave the country he ruled for almost 4 decades. Juan Carlos I won acclaim for guiding the nation after the death of Franco. But in recent years, he's faced a series of scandals and legal woes that have tarnished his image. He did not say when he will leave Spain or where his self-exile will take him. Global news, 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now let's kick it off with the U.S. and Federal Reserve officials are warning of the urgency of another round of fiscal aid to support the U.S. economy. It comes as the political stalemate continues and Democrats and Republicans are struggling to agree on what's needed. Enhanced benefits payments of $600 a week expired at the end of last month. Democrats wanted to extend the program, but Republicans wanted it reduced, arguing it was too generous and discouraged people from returning to work. Well, joining us this morning is John Wraith. He's head of UK and European rate strategy at UBS. John, as always, thank you so much for joining us. When you look at, what treasuries are looking at, what kind of stimulus do you think they're pricing in, if any?
Well, I think, Francine, one thing that's interesting, if you look, for example, at the 10-year point on the curve, is that it's all about real yields. Real yields are at record lows. The other side of yields, in other words, inflation expectations, are at perfectly stable levels. In other words, investors are saying that the outlook for inflation in the medium term is not concerning. It's the outlook for growth, real growth. So policies that stimulate that, or at least support the economy through the current situation, are the ones that are going to reassure investors. And I think that's why perhaps partly the Fed is saying it's not about monetary policy, it's not about trying to stimulate inflationary pressures, it's about fiscal support for, in this instance, US consumers and businesses, and that's what they're urging the government to look into more.
John, where do you see the best value amongst fixed income?
Well, I mean, it's a difficult one because fundamentally yields in all of these markets are arguably much lower than fundamentals suggest when you consider how much borrowing is going on. But that is partly driven by risk aversion, but also the programs by central banks to buy bonds aggressively to keep yields suppressed. It seems that, with uncertainty still as elevated as it is, they're going to have to keep doing that for some time, some considerable time to come. So I think for now, the best bet remains that yields will stay very suppressed. If we see better news on the outlook for the pandemic, whether it be from the treatment or economies re-accelerating without the infection rate picking up dramatically, then at that point yields will start to drift higher. But for now, they seem to be in a holding pattern at these very low levels.
When you look at the path to the recovery, John, how difficult is it to know what kind of recovery we'll get? Is it going to be patchy? Is it going to be one step forward, 2 steps backwards?
I mean, obviously that is the key question in all of this, Francine. And I think, we would say that, we're through the first act and maybe a scene or two of a big 5-act play that no one knows the ending of or the narrative of. Some policymakers, some investors are obviously more optimistic. They're looking for more of a V-shaped rebound. Others more concerned that as restrictions are eased, we'll see infection rates pick up and it will require these sort of rolling lockdowns until and unless we get a medical solution essentially to the virus, which of course could be some significant way off. It's really a matter of opinion, I think, as much as trying to follow the science and the evidence. And for now, those doubts are very elevated as we see this early easing of restrictions triggering all manner of responses, both in terms of economic performance and the progress of the pandemic itself. So I think it is more of a matter of opinion than fact at this point, and it makes forecasting very difficult, and it makes investor decision-making very difficult as well.
Yeah, what do treasuries tell us, or what does the fixed income space tell us about what's to come?
I think it tells us that risk aversion is alive and well. As I said before, if you look at what real yields and inflation expectations are telling you in combination, it is concerns about the real growth outlook more than worries about a long-term period of deflation or disinflation. So central banks on that level at least don't need to worry about deflation expectations becoming entrenched. But they're also telling you that central banks are going to carry on buying these bonds in very large numbers, and as long as risk aversion increases demand as well for the safest assets, then as we said, yields are likely to stay around these sorts of levels and will only start to rise materially when the concerns about the economic and health outlook are materially alleviated.
I mean, you say we shouldn't worry about deflation. 18 months from now, should we worry about rampant inflation?
Well, I think, when I say we don't need to worry about deflation, I mean in the minds of investors into the medium term. Clearly, in the short term, with demand hit as hard as it has been, and as hard as it may go on being hit, there are clearly some fairly strong disinflationary forces at work. And in all of the major economies, unsurprisingly, so far this year, we've seen headline inflation fall or slow significantly towards zero or thereabouts in most of these major economies. And clearly it may slow further in the short term. But, this is one of the issues policymakers face if they overstimulate by erring understandably on the side of caution and an aggressive response, only to find that economies have reaccelerated sooner than they anticipated. Then yes, there will be some inflation to deal with, as you say, 18 months, perhaps 2 years down the line. But, to use an old cliche, that's a nice problem for them. That's a problem they'd like to have, to chase down at least slightly elevated inflation if it's about economies recovering. So they will err on the side of doing more rather than less and deal with any overstimulus in due course, if that is what they transpire to have injected into these economies.
John, is there a part of the world that's at risk of, the stimulus doing too much? Or do we just not know yet?
I think we just don't know. I mean, others may have more informed opinions than I do, but I think certainly from everything we can see, there just isn't any certainty over when or how this pandemic is going to stop being a significant influence over the global economy and by extension, because it is everywhere, an influence over every single one of these independent national economies as well. And as I said before, some are more optimistic than others and some will have their own views on this. But my opinion is the uncertainty remains very elevated, and until we have some clarity over how and when this ends, I think markets are going to have to just keep trading in the dark to a large extent.
John, thanks so much. John Wraith there from UBS stays with us. Now, coming up, the Bank of England is set to keep its foot on the gas of ultra-loose monetary policy this week. Disagreements emerge over the shape of the recovery, though. We'll discuss that next with John Wraith. This is Bloomberg.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Thanks, Francine. BP has cut its dividend for the first time in a decade. It was widely expected after Shell made a similar move, but it was unthinkable before this year. Big Oil's generous payouts have long been one of its main attractions to investors. BP reported an adjusted loss of nearly $6.7 billion, but not as bad as expected. Bayer says the pandemic has hurt demand for some of its medicines, hitting outlook for the year. The slowdown in non-essential medical procedures hurt Bayer's pharma division. Its consumer health unit got a boost earlier this year from people stockpiling over-the-counter medicines, but that effect waned in the second quarter. Commerzbank has appointed Hans-Jörg Vetter as its supervisory board chairman. It's a blow to the second biggest shareholder, Cerberus, which tried to block the move. The private equity firm launched a campaign in June to change the lender's strategy. It resulted in the exit of the bank's chairman and CEO. And that's the Bloomberg Business Flash. Francine.
Thanks so much, Laura. Now, the Bank of England is set to keep its foot on the gas of ultra-loose monetary policy when it meets this Thursday. Now, that's despite some disagreement over policymakers over the pace of the UK's recovery from recession. Well, the BOE chief economist, Andy Haldane, is optimistic about a quick rebound, saying it is early days, but my reading of the evidence is so far a V-shaped recovery. Others warn bounce back could be slower. Well, still with us, John Waith from UBS. John, first of all, what kind of recovery are you expecting?
Probably something in between those two extremes. We're not looking for a sort of rapid V-shaped recovery for some of the obvious reasons we touched on before. We've seen a partial easing of restrictions, only for some backward steps to then be taken when evidence has emerged that the infection rate pretty much immediately reaccelerates. So for us, it's hard to see how things can suddenly dramatically improve. But we do hope and think that we're through the worst of the pandemic and the associated restrictions, and therefore see slightly better prospects for the economy going forward. For us, that's a recipe for policy to stay where it is for the time being. And as I mentioned before, we think the committee in the UK and elsewhere will err on the side of doing more rather than less, because if things start to go wrong again, clearly the need for stimulus is going to become pretty urgent.
Does that also, I guess, safeguard any kind of consequence, of Brexit if there's a no deal come December?
Well, that's an interesting sort of extra layer for the UK, of course, that we do have on our radar screen, albeit it's not front and centre at the moment because of the obvious current issue with the pandemic. But yes, in Q3 and more particularly Q4, even if the pandemic does ease off, even if the economy is reaccelerating, there is then this extra hurdle and uncertainty that is not specific and explicit to the UK, but clearly most relevant for the UK. Our opinion is that situation will be handled not necessarily with a comprehensive deal, but at least with arrangements to stop the worst of the possible disruption, which benefits neither the UK nor the wider European Union. But clearly, it is another layer of uncertainty, and it does give us some additional concerns for the UK, for sterling, for momentum and activity going into the second half, and more particularly the fourth quarter of the year.
Where do you see the most scarring in the UK economy, John? Is it unemployment? Is it somewhere else?
Well, at the moment, it's not really unemployment because of the furlough scheme, but of course, that is due to end completely in the UK in October, which is somewhat earlier than other economies, albeit all the schemes are slightly different in nature. And we've seen the first pairing of that furlough scheme back literally this week, with employers having to pay national insurance and pension contributions again. So the government will be looking very closely at how companies respond to having to pick up some of those costs again. And if the pandemic is still as great an influence come September, October, it's pretty hard to see that furlough scheme ending, because if it does, without essentially people being able to go back to their jobs because their businesses haven't reopened yet, then we are going to see a significant spike in unemployment. So in that scenario, we'd expect the furlough scheme to be extended. So at least in terms of headline unemployment, the underlying impact of the pandemic is kept at bay, at least for the time being, and hopefully longer term as well.
John, thank you so much. John Wraith there, head of UK and European rate strategy at UBS. Now coming up, it was the 20 minutes that broke the oil market when the price of crude briefly hits minus $37 a barrel in April. One group of traders in London made as much as $500 million. We'll bring you the story next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, it was the 20 minutes that broke the oil market. Back in April, as the coronavirus crisis was roiling assets, the price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office above a pub in central London, it was a very, very profitable day. As this week's Bloomberg Business Week reveals, they pocketed as much as $500 million. Now, let's talk about this with Bloomberg's Liam Vaughan, who also co-authored the story. Liam, thank you for joining us. Who are Vega Capital London, and how did they make so much money?
Hi, Francine. Yeah, I mean, that's the million-dollar question, really. I mean, Vega Capital London is literally a tiny firm with, at most, a couple of dozen traders. They've got an office above a pub near Liverpool Street Station, and, you know, the firm was formed in 2016. Very few people have really heard of them. In reporting this story, it was quite hard to find any information at all. All we do know is that lots of them used to work in the days that, you know, in the pits, buying and selling oil, you know, in the old London pits. You know, as our story today talks about, that day they managed to place a trade which involved buying oil at the settlement price and selling it throughout the day. Well, as you'll recall, the settlement price of oil that day was minus $37. So it meant that rather than having to buy oil, they got paid on both sides of the trade. I mean, by far and away, it was the biggest ever move in the oil market history by a factor of, several times. And therefore, their trade, even though they're a small firm, pocketed them $500 million. You know, we're not talking about J.P. Morgan or Goldman Sachs or Glencore here. We're talking about a bunch of prop traders above a pub.
I mean, it's just quite incredible. Why are the regulators interested?
So as you can imagine, there was a lot of scrutiny over exactly what happened that day, not least because lots of people lost a lot of money. There was retail investors that had invested in funds that track the oil contract in question. They lost literally billions of dollars. So, you know, if it emerges that these guys traded in such a way that it influenced the market, and, you know, considering there was so little liquidity that day, there's strong reason to have a look at that. Then, the regulators are very interested to find out whether they played a part.
Liam, what's the fallout from all of this? Will it change the way some people will operate?
I mean, the fallout at this point could be literally anything. I mean, the WTI contract is baked into hundreds of billions of contracts. There's been oil companies, there's been investors from all across the entire spectrum that have had huge losses from this. The CME, which runs the exchange, turned around the next day after the fall and said, nothing to see here. This was supply and demand. The markets behaved perfectly. Well, you know, if our story is accurate, which we know that it is, then that's not a fair assessment of what happened that day. And there's going to be a lot of questions of the regulator, of the exchange, and also, you know, lots of people trying to get their money back.
Liam, I know you also, wrote a couple, well, it took you more than a couple of months, but a couple of months ago, your great book, Flash Crash, came out. Are regulators in general just much more aware of the way the markets operate now as compared to in the past?
I mean, one of the amazing things about this story is that it's almost like a sort of carbon copy of the flash crash, where basically you have this really huge global event in financial markets. You have a kind of attempt at scrutiny after the event where regulators are sort of turning around and saying, what happened here? And then beneath it all, you have a relatively tiny player that seems to have had a massively oversized impact on the markets. And I think it's just very telling that, time and time again, we seem to read these stories that reveal, I think, what really goes on sometimes in financial markets that isn't necessarily the story that first emerges or is what's told, what you hear from the regulators and the exchanges. But thanks for plugging the book, and it's still available now. It's Flash Crash.
Yeah, I was going to do it. Liam Vaughan there, and you can read the full story of that remarkable day on Bloomberg Business Week. And I was going to say, also, he's the author of Flash Crash, a trading savant, a global manhunt, and the most mysterious market crash in history. It's a great read. Perfect, really, for an August summer read. Coming up, we talk more about markets. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, this is what the markets are doing. A lot of the focus, of course, is on some of the earnings out here in Europe. BP cutting its dividend as the virus has been hastening moves to curb some of the oil output that we saw out there. Now, stocks are fluctuating in Europe, failing to carry forward the momentum from Asia and Wall Street. We did see in the U.S. a technology-fueled rally that got support also from positive momentum. Treasuries maintaining losses. Now, let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Thanks, Francine. Federal Reserve officials are warning that another round of fiscal relief will be critical for the U.S. economy. The comments come as lawmakers continue to be deadlocked over a new aid package. President Donald Trump is now considering executive action to support Americans hit by the pandemic. He wants to impose a moratorium on evictions and enact a payroll tax holiday. The U.S. needs to borrow a lot more money. The Treasury says it expects to raise nearly $950 billion in debt over the 3 months through September. That's to fund the massive spending surge to help the economy through the coronavirus crisis. The figure is $270 billion higher than the projection back in May. The Bank of England may be undermining the UK's push for a green recovery. That's the finding of the think tank, the New Economics Foundation. Its report says the central bank is effectively subsidising polluting industries with its pandemic rescue programme. It says large amounts of money have been pumped into the dirtiest sectors, despite being smaller parts of the economy.
创造性的结合，充分发挥市场在资源配置中的决定性作用，更好地发挥正作用，把握好生存与发展。
Artificial intelligence is replacing isolation rules. It's the latest policy to battle a spike in coronavirus cases. On-the-spot fines could be around $3,500 US. Repeat offenders may see a court penalty of 4 times as much. Victoria has imposed a curfew on the city of Melbourne and a statewide lockdown. Spain's former king is planning to leave the country. He ruled for almost 4 decades. Juan Carlos I won acclaim for guiding the nation after the death of Franco. But in recent years, he's faced a series of scandals and legal woes that have tarnished his image. He did not say when he will leave Spain or where his self-exile will take him. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now let's focus on the battle for the world's most valuable startup company. President Trump says ByteDance must sell TikTok's U.S. operations by the 15th of September, or else it will have to close down. In an unexpected intervention, the president also said the U.S. government should receive a cut of any deal. Now, Microsoft shares rose yesterday after it confirmed it was looking to complete a TikTok purchase by mid-September. Joining us now to discuss all of this is Richard Windsor, founder of Radio Free Mobile. Richard, thank you so much for joining us. How does this end?
Good morning, Francine. Well, it ends in one of two ways. Either Microsoft can find a route between ByteDance and the US government to acquire TikTok and isolate it from China, or by the September the 15th, an executive order is signed, and just like in India, you get this exodus of users to alternative platforms in the United States and other countries.
You know, is Microsoft going to clinch the deal? Are there other people that will try and get a piece on the action?
Well, I think my gut said I think Microsoft will acquire it simply because because ByteDance is facing a total shutdown of its business, it's obviously going to be willing to sell it at a reduced price, which creates a financial incentive for Microsoft to buy it, isolate it, and then potentially to relist it or sell it on, which means other potential interested parties could be maybe a consortium of private equity who can see the financial return. Question is, though, is that can they actually maintain the intellectual property and the algorithm that makes TikTok such a successful app?
Richard, what happens with TikTok? So let's say that Microsoft actually buys it. Who does it take market share from, if anyone?
Well, basically what it is doing at the moment, if you look at the what we call the digital life pie, which is how we look at the addressable market for users' attention, TikTok sits in the instant messaging media consumption space. So where it will be taking, if it continues to grow its engagement in the United States, it'll be taking a bit of share from Instagram, it'll be taking a bit of share from WhatsApp, from YouTube, basically Google and Facebook, which is potentially, you know, why Microsoft is quite a good choice as a destination for this asset, at least temporarily.
Is this a deal of a decade for Microsoft?
No, I don't think so. You know, it's you know, since Satya Nadella took over, there've been a series of quite good acquisitions, and LinkedIn's gone very well, as well as a couple of others. I think what it could signify is a very healthy return on investment for Microsoft. Look at the scenario. So Microsoft takes it. Microsoft has a reasonable activity in AI already, so it then takes a license from ByteDance for that really good algorithm for recommending videos that users like, and it's able to use its own in-house expertise to migrate that, to keep it fresh, to keep it active. You completely isolate it, you run everything on Azure, which is Microsoft's cloud platform, and then when you start to monetize and cash flow starts to turn positive, you think about sale or IPO, and you earn a very healthy return, because strategically, for me, it makes no sense for Microsoft to own this asset at all.
Richard, so we have this, you know, added layer of complexity with Congress and the Trump administration. You know, what is the read across for other deals to come?
I think what it means is, and you know, this has been on the cards really ever since the pandemic began, there has been a hardening of the stance, not just in the United States, but also in the UK, parts of Europe, Australia, and New Zealand, against China and Chinese perceptions of, is China stealing data about its citizens, and so on and so forth. What that really means is that going forward, if you are doing a deal with China that requires regulatory approval, it's going to be much, much more difficult. And I think you can say that right the way across the board.
Richard, given where we are on, you know, some of these tech giants and what we heard from Amazon, what we saw from Google, are they going to be also on an acquiring phase? I mean, the returns they had, especially Amazon, were really quite impressive.
I think that you actually saw something from Google this morning, which was it's done a deal with ADT and taken a 6.6% stake, and that's kind of like to hit back and try and get back into the smart home security space. So it wouldn't be surprised me further down the road that Google might end up acquiring ADT, perhaps, if things go quite well. So I think what you're going to see is also what you're also seeing is in the time of the pandemic, life gets hard for small companies, and that really means is that, you know, there's going to be some interesting companies that are struggling financially that arguably would make good acquisitions for the larger guys who've got still have huge resources.
All right, Richard, thanks so much. Richard Windsor, their founder of Radio Free Mobile. Thank you so much for joining us. Now, we're also getting a bit of breaking news out of the ECB. This is Philip Blaine saying the ECB is committed to providing necessary stimulus. He also says the overall PPP envelope is a core determinant of the ECB stance, and he also says it is unwise to draw strong conclusions from the second quarter GDP data. I don't know whether it's moving, actually, euro, but certainly something that we need to keep an eye on. Coming up, we'll hear from the chief executive of Diageo as a pandemic weighs on sales. The drinks maker was hit hard by the closure of bars and restaurants. That's coming up shortly, and this is Bloomberg.
Good morning, everybody. I'm placing a new order to buy euro at 117.79. The order placed to buy at 117.79.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, after weeks of negotiations and, of course, speculation about what would happen to Argentina, it says now that it's reached a credit deal with a debt deal with its creditor groups. So this is what we're looking at overall. I don't know if we have if we can actually look at what's been happening to some of the bonds over in Argentina, but there were certainly signs that were increasing about some of the Argentines losing faith in the peso, and we went through chart by chart exactly to see how much pressure there was on the peso. We were looking at dollar purchases, we were looking at the black market peso, but also future demand. So just seconds ago, of course, that headline coming in from Argentina extending a bond invitation deadline to August 24th. We'll have plenty more on Argentina shortly, but now let's get straight to the Bloomberg Business Flash. Here in London is Laura Wright. Hi, Laura.
Thanks, Francine. Twitter is being investigated by the Federal Trade Commission for alleged privacy violations. It's another setback for the company that struggled in recent years to protect user data and account security. The FTC is probing the use of phone numbers uploaded for security purposes to target people with advertising. U.S. aviation regulators have proposed a long list of fixes for Boeing's grounded 737 MAX. It's one of the most extensive set of requirements the agency has ever issued following an accident. The release by the Federal Aviation Administration is a major step in getting the 737 MAX back into the air. BP has cut its dividend for the first time in a decade. It was widely expected after Shell made a similar move, but it was unthinkable before this year. Big Oil's generous payouts have long been one of its main attractions to investors. BP reported an adjusted loss of nearly $6.7 billion, but not as bad as expected. Sony is giving a conservative forecast for the year after reporting profit that topped estimates. The PlayStation 5 coming this holiday season has undercut some existing hardware sales, but the pandemic has fueled demand for its games, and Bloomberg has learned the company is asking suppliers to roughly double the number of PlayStation 5 units in anticipation of higher sales. Commerzbank has appointed Hans-Jörg Vetter as its supervisory board chairman. It's a blow to its second biggest shareholder, Cerberus, which tried to block the move. The private equity firm launched a campaign in June to change the lender's strategy. It resulted in the exits of the bank's chairman and the CEO. That's the Bloomberg Business Flash. Francine.
Thank you so much, Laura. Now let's stick with earnings season, and Diageo shares are slumping after it reported full-year results that missed estimates. The spirits company didn't provide guidance for the following year, and sales at Diageo were hit hard as the pandemic led to the closure of bars and restaurants, with e-commerce and supermarket purchases failing to fill the gap. While the chief executive, Ivan Menezes, told Bloomberg he feels positive about the consumer response online. Here he is.
The two things consumers want most coming out of lockdown and these conditions is meeting up with family and friends and going out to a bar or a restaurant or pub or a festival. So that human motivation, we believe, was going to endure. And as conditions improve, we'll see consumers go right back in. But what we're doing in the meantime, actually, is creating the experiences at home. So one of the trends you've seen is cooking from scratch and baking has picked up. So with Bailey's, we moved right into that space on social media and digital engagement, and we've seen a very good response from markets like China to the United States, where Bailey's is doing better. Johnny Walker, we have a program called Kitchen Sink Drinks, where online we look at what ingredients you have in your fridge at home and design cocktails that you can make at home, because there's a huge desire to get bar quality cocktails at home. To your point on consumption levels, they haven't gone up. In fact, we've seen sequentially per capita consumption come down for a long time. We obviously stand very much for drinking in moderation and drinking sensibly. You have seen the shift from out of home to in home, but say in a market like the UK, where 40% of the business is out of home, I mean, that has collapsed. The in-home consumption has picked up, but total alcohol has dropped about 20%. So it is not true that the overall populations are drinking more. You are seeing the shift from out of home to in-home. But what we're encouraged by is the trends towards premiumization. We were talking about tequila. Casamigos, Don Julio, these are $50 bottles of tequila, are growing double-digit right now. So we're seeing that trend also sustain, particularly in the United States.
Well, and it's your margins. It's your margins, I know, Ivan, that investors have really appreciated. And I wonder if they can expect a boost in revenue with those big margins to really help in the second half or in fiscal 2021. I mean, you're seeing, I assume, a comeback in places like China as a precursor to what you expect in the Western world. So can you tell us from that what kind of quality you expect in a sales recovery?
Yeah, so what we're looking at, our last quarter was the weakest quarter because it had the biggest impact of the lockdowns around the world. We are seeing sequential improvement even in the last quarter.
I have to remove order to buy euro. It takes too long to execute it.
Every day, every week is getting better. The on-premise is reopening, and we're seeing consumption pick up in the on-trade. The same happens in like the UK, where the pubs have opened a few weeks ago. We are seeing steady recovery. Footfall is at about 70% of normal. The beer business in the first couple of weeks was 70% of normal. But we expect that to improve, but clearly it is based on the conditions of the virus and government policies also that will impact it. But overall, across the world, we do expect sequential improvement for Diageo.
Well, that was the Diageo Chief Executive Officer, Ivan Menezes, speaking to Bloomberg this morning. Now, coming up, a new ESG record. Google parent Alphabet sells nearly $6 billion of bonds in the largest corporate bond offering of its kind. We'll have the details. Plus, we'll also talk about that latest headline from Argentina. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, just about 10 minutes or so ago, we had some breaking news out of Argentina. Now, this is, of course, something that investors have been wanting to know more on. If you look at what bonds have been doing, they had been climbing to a 5-month high on optimism of a debt deal. Now, this is what we know so far. First of all, Argentina says it reached a debt deal with creditor groups, and we'll have to keep a very close eye on exactly the details and what that means going forward for Argentina. So that was just the latest from Argentina in just the last 10 minutes. Now, turning to an important topic of diversity, at 22 years old, Lauren Simmons became the youngest ever woman to trade at the New York Stock Exchange back in 2017. She was also the second black woman to ever hold such a spot. The entrepreneur and former equity trader at Rosenblatt Securities told Bloomberg that recruitment on Wall Street needs to change.
They're going to have to be okay with putting themselves in different scenarios. Obviously, how their recruiting process over years, centuries has not worked to get different type of talent. And so they're going to have to go out to, they can, find people in New York, they can find people in middle America, but they're going to have to stop with the traditional going to Ivy Leagues and picking from a certain demographic.
Well, we also spoke with Zanelia Harris, president of Harris and Harris Wealth Management, who said there's far from enough representation in the industry.
I do think that there's an opportunity for Wall Street to embrace diversity for sure. And one of the reasons why I think that there's room for growth is because as you highlighted in the article, so many of us have gone there with the hopes of achieving success to then deal with the harsh reality of not being able to reach the levels that we've seen our white counterparts reach. And that has been disheartening for me because I wanted to succeed. When I came out of college, my goal was to achieve the American dream.
Now, sticking with representation on Wall Street, Google parent Alphabet has just tapped the high-grade bond market, aiming to support black entrepreneurs amongst other social causes. Here to explain the tech giant's record on ESG bond offering is our Danny Berger. Danny, take it away.
Francine, this was a record bond offering in a lot of ways, $10 billion in total, and there were record low yields here for their 7-year and 40-year yields, beating out a record previously set by Amazon. But more notably, about half of those proceeds are specifically for ESG type bonds. So that includes things like supporting small and medium businesses that are hit by COVID, environmental issues like green housing, and importantly, supporting black entrepreneurs. Now, this is notable at Google because the company has really struggled to diversify their ranks. Just 2.6% of the leadership at Google is black, and that's unchanged from last year. So Google has undertaken an initiative, which they're calling the Economic Opportunity Package, and that is supported by $175 million. That includes black-led venture capital firms and startups backing for them, education, and they've
also committed to increasing diversity and specifically Black employees, hiring them into higher ranks at the firm, Francine.
More generally, Danny, how popular are these ESG and socially backed bonds?
They've really taken off this year, Francine. We've seen these types of social bonds grow in issuance by over 370% in the first half of 2020 compared to last year. Some of that is due to the coronavirus. We're seeing just more of these issuances to help deal with some of the social impact due to the virus. But overall, it's already hit a record, and we haven't even finished the year yet. And so we're just seeing a lot of more investors interested in this issue and realizing that it can get them better returns. For example, Moody's recently rating Lloyd's better credit rating-wise based on one of their diversity initiatives that they're undertaking.
Danny, thank you so much. Danny Berger there with the very latest on this important issue. You can also catch more of our coverage and our interviews in the latest issue of the Markets magazine, a special edition out now that's taking a closer look at diversity. Now, Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York. We'll talk a lot about Argentina, saying just moments ago that it reached a debt deal with its creditor groups. At the same time, Argentina has extended its bond invitation deadline to August 24th. That adjusts payment dates and clauses from the original offer. So we'll have plenty more on Argentina and emerging markets. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Ticking clock, President Trump says TikTok must close its U.S. operations by September 15th unless it is sold. He insists any sale must include a substantial payment to the U.S. government. BP cuts its dividend for the first time since a Gulf oil spill, but the oil giant's loss is narrower than expected. And the 20 minutes that broke the oil market when the price of crude went negative back in April, for one group of traders, it was a very, very profitable day. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, discovering TikTok today, so I'm really excited about seeing everything that you put online.
I almost missed the show opening, Francine. You know, I'm like, we're talking about TikTok, and
I'm aware.
I wouldn't even know this. You're aware I almost missed the show opening. I'm looking at the cat videos and the dog videos, and about 80% of it I couldn't play on TV because it's not...
Surveillance videos with good music may be coming to you shortly.
With your great job on Instagram, maybe we ought to get you out on TikTok and, you know, advance the show. Maybe not. It's an extraordinary story. This is really, Francine, exploded last night with the president's comments on how the Treasury of the United States should get some form of, quote, key money within this transaction. As you know, Francine, Bloomberg reporting on the response from the Chinese, it's been abrupt.
Yeah, it certainly is. There you go, finder's fee. I mean, you know, it's not something that we've seen so much of in the past. And Tommy, if you look at what it means for Microsoft, it could be the deal of a decade, so we'll explore that shortly. But now let's get straight to the Bloomberg. First Word News in New York City is Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom, President Trump may take executive action if Congress can't agree on a new coronavirus stimulus package. The president told reporters he might impose a moratorium on evictions and enact a payroll tax holiday. The White House is also exploring whether the president can act on his own to extend enhanced unemployment insurance payments. President Trump insists that if TikTok's U.S. operations are sold, the U.S. government should get a cut. But it's not clear under what authority the president could extract a payout. He said the money would come from China or from an American buyer such as Microsoft. Earlier in the day, the president said TikTok would have to close in the U.S. by September 15th unless an American company buys it. Hurricane Isaias was downgraded to a tropical storm as it made landfall and moved inland over North Carolina. It's prompted tropical storm warnings all the way to Maine, including Manhattan. Temporary flood barriers and platforms have been deployed in New York City. The storm doesn't pose a threat to any major oil refineries or platforms. And Northern Ireland faces a Brexit food time bomb. Extra paperwork will raise British supermarkets' cost of operating there so much that some may pull out. That's according to the Northern Ireland Retail Consortium. Starting January the 1st, animal products transported from the rest of Britain to Northern Ireland will require export certificates. That could add $52,000 to the cost of each shipment. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. And I had to read you the data check today, folks, because buried in all the Bloomberg data that we look at every day, I missed the TIPS yield. Futures at -9 right now, and the VIX 24.36, suggesting doldrums. You do not see it in the bond market. Yeah, yields are a little higher over the last couple of days, but the 10-year TIPS is a negative 1.0405. That is an extraordinary statistic to see, absolutely extraordinary, and really bodes important for this mystery, which is the Friday jobs report. Francine?
Tom, I'm looking at stocks are edging down in Europe, but U.S. futures also down a touch. Investors are waiting for word on whether we're going to see fresh fiscal stimulus in the U.S. and whether, you know, they get the necessary approval. And it's something that I don't do very often, but I actually want to show you Argentinian peso because the ministry put some, you know, headlines out about 15 minutes ago saying it reached a debt deal with creditor groups, but at the same time, it actually extended bond invitations deadline to August 24th. So it's unclear at the moment whether it's 100% a positive or actually, you know, it's just pushing back the deadline. And then I just wanted to show you crude oil because everything that's going on also with BP at 40.56. Now, senior Democrats announced some progress on the next phase of U.S. stimulus and agreed to meet again today. Here is Senator Chuck Schumer yesterday after a meeting with White House officials.
We are really getting an understanding of each side's position, and we're making some progress on certain issues, moving closer together. There are a lot of issues that are still outstanding, but I think there is a desire to get something done as soon as we can. And so we'll continue to work. The staffs will be working.
Well, that was Senator Schumer speaking on Capitol Hill yesterday. Well, joining us now is Amy Pope, Chatham House Associate Fellow of the U.S. and the Americas Program, also former U.S. Deputy Homeland Security Advisor to President Obama. Amy Pope, thank you for joining us. Have we turned a corner? Are the two sides, or the three sides and the fourth side, given how split the Republicans are, ready to find an agreement?
Well, look, they all know that they actually have to find an agreement at some point. There's pressure on all sides. No one really wins if they can't find an agreement and if Americans continue to suffer. So while there's going to be a lot of posturing, in the end, no one wants to be the reason why they can't actually come to a deal. So I expect that it's a matter of time.
What needs to be in the final bill?
There needs to be support for Americans. The most recent economic analysis that's come out that's shown real hits in the American economy is translating to people who are on the ground, which means that they have very serious concerns about whether they can make their bills. So that kind of pocketbook impact is going to make a big difference to Americans. And everybody knows that the election is just around the corner. And that's a moment in time where they want to make sure that Americans are not blaming them for their particular economic circumstance.
Amy, the mythology here is out of the 80s, which is less government. The federal government is, something inefficient, et cetera. And it's steamrolled over the decades to a point where we have a legislature that can't legislate, certain parties divided, et cetera, and a president who clearly doesn't want to be part of the so-called swamp. Are we able to legislate now?
That's a great question. The bottom line, though, is at moments like this, real crisis where the economy is struggling, where the coronavirus is really taking hold in the United States in a way no one really anticipated, now more than ever is time for legislators to get together and come up with a compromise. Now, whether they can do that, ultimately, I think in the end, they'll pull it out. But they're going to keep people biting their nails on the sidelines until then.
Well, the idea of compromise seems so incredibly simplistic given the emergency. And, at Bloomberg, we don't take sides on this debate. What is blocking compromise?
No one wants to look like they gave in to the other side. Again, the election year politics here and the dynamic that is playing at this particular moment in time, it just can't be underestimated. No one wants to go into an election suggesting that they were soft on some issue or they didn't stand up to President Trump. So that's really what's at play. I hate to say this, but I think talking points and politics are dominating over some common sense and good outcomes. But again, ultimately, everyone knows they have to get there in the end. And so I really anticipate they'll get there after some posturing along the way.
Amy, if they leave it too long, how much worse off will people be, and how will that translate into voting in November? Who are they blaming?
I think they blame the president, ultimately. I mean, look, the president has the White House, obviously. The Republicans hold the Senate. The Democrats have a very small amount of leverage. It's not insignificant. They are and can use it to their advantage. But in the end, people look to the president when it comes to evaluating their own circumstance and whether or not they think the country is going in the right direction. So there's a lot at stake here for him. And ultimately, the real question is, why isn't he getting into the middle and trying to navigate or negotiate the deal himself?
Amy, frankly, some of the rhetoric or some of the commentary regarding TikTok, it seems a bit bizarre about the U.S. administration getting some kind of finder's fee if TikTok gets taken out. I mean, how will that be taken in the inner circles of the president?
It's really unusual, and I'm sure everyone there is sort of scratching their head. There are legitimate security concerns about Chinese technology companies. That's one of the reasons why there's a law called CFIUS that evaluates whether or not certain deals can and should go through if there are national security concerns. That's the right place for something like this to be worked out. It's not the president weighing in on whether a deal can happen or whether the United States should get some sort of fee. All of that is highly unusual. It's not entirely clear that he can do that legally. And I'm sure his advisors are confused as to what his objective is here.
what is the Chinese objective? I mean, we've had a wonderful response overnight from China with clarity about theft, etc. Do you perceive TikTok as a private company? Or in China, Amy, is there no such thing as a private company?
I'm skeptical that in China any company can fully function independently. I mean, we saw just a year ago with the Hong Kong protests in Cathay Pacific, real pressure from the Chinese government to reveal employees who were protesting and to take action against them. We should not assume that China will keep its hands off of any company that's operating there.
How do you believe that America will extricate itself from this TikTok mess? I mean, it's hugely unpredictable right now, but does it just collapse past September 15th?
I think it could collapse. Look, I think the president is using this, as he often does, as a way to distract from some much more serious issues that are happening. He knows that the issue of China really resonates with his base. It gives him the opportunity to look tough and to look like he's negotiating some kind of deal. But really what he's doing is distracting from the much more serious issues that the United States is facing at the moment, where he really needs to be using his influence. And that, for example, is what we were just discussing before, negotiating a deal to help Americans get through this very significant crisis.
Amy, thanks so much, as always. Amy Pope there, Chatham House Associate Fellow of U.S. and the Americas Program and former U.S. Deputy Homeland Security Advisor to President Obama. Now, later today, the former U.S. Commerce Secretary, Penny Pritzker, that interview 5 p.m. in New York, that's 10 p.m. in London, and this is Bloomberg.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and business is depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality. Ultimately, inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The United States should get a very large percentage of that price because we're making it possible. Without us, you know, I use the expression, it's like the landlord and the tenant. And without the lease, the tenant doesn't have the value. Well, we're sort of, in a certain way, the lease. We make it possible to have this great success.
Absolutely historic in the history of this nation to see the president, any president, talk about a transactional fee of some form. This is really difficult language, unclear language right now to the government on a corporate transaction. It's been bouncing around here for the last 12 hours in different permutations. Of course, the Chinese have responded, talking about theft. Right now, we speak with Derek Wallbank in Singapore, our senior editor, but with substantial operational work in Washington over the years. Derek, I'm sure you, as everybody else of any political persuasion, was stunned by these comments. Where'd they come from?
Yeah, Tom, I really was. The idea of having a sort of finder's fee that's involved in a sort of required corporate takeover that's a result of some form of sanction is really kind of unprecedented, and it's not really clear where the U.S. government will have some sort of legal justification of what the statute is that they would be looking at that would underpin something like that. Certainly there is some case for some unrelated things, but not for something like this that anyone's talked about so far.
3 years into an administration, is this just an issue where we basically ignore it because it will go away?
Well, something's got to be resolved by September 15th. So there's a time limit on this. This isn't like Mexico paying for the wall here, Tom, where that's an open-ended thing that may or may not ever happen. This actually has a date certain. So at some point, Trump has to fold on this, or someone has to figure out some justification, or there's some fig leaf that gets put forward. But there is actually a date certain, and that makes this different than other things.
Derek, what's an elegant way of finding a resolution to this?
Oh, goodness. It's hard to say. You could, sometimes on state and local things, when the government's trying to take a benefit, you talk about job creation, you talk about some other things, you talk about future tax revenue, something like that. There are a lot of ways to get around this to say that there's a government benefit. In terms of an actual direct payment from ByteDance to the U.S. government, from Microsoft to the U.S. government, that is a much harder thing to contemplate to figure out how that necessarily works. Maybe there's a creative legal theory that's going to get put out in the next couple of days to weeks, but so far we haven't quite seen it, and I think everyone was really taken aback by that red headline yesterday.
Derek, I mean, what does that mean for Microsoft or whoever buys it? Are they then tied to, you know, the U.S. administration? Is it something that we need to explore a bit further?
Yeah, I think there is more to explore here. I think certainly for Microsoft, you know, you look at something like TikTok, it's a potentially transformational technology. It's certainly something where people have gotten a lot of adoption, and those things don't come around every day. So the chance of acquisition here is certainly a valuable opportunity. It's also a valuable opportunity in terms of pricing to get something under pressure potentially. Again, you know, we don't know what these deals might look like, but certainly you can imagine that there might be some price pressure here because there is this date certain. So there is some opportunity for Microsoft, but obviously there's also some risk here in terms of getting involved in this. Because this is such a governmental mandate, it could potentially change if the sort of winds of change inside the White House blew slightly differently. So there is certainly some risk, some Twitter account risk, let's say it that way, to anything that goes forward in this space.
Derek, I want to rip up the script here, and we've got to go to your attendance in Singapore right now. Has Singapore seen any changes or difference after the uproar in Hong Kong, the new changes in security and liberties in Hong Kong? Do you detect any change in Singapore yet?
We're seeing some explorative change, Tom, in terms of people looking to put money here, to looking to maybe invest here. In terms of packed Singapore Airlines flights headed here with people moving their entire industries here, we're not really seeing that as yet. And the Singapore government is being really careful about how they play this, because they are really trying not to look like they're scoring opportunity off of Hong Kong. That's not the vibe that they want to project here. But in terms of exploration, are we seeing people do this? Yes. Are we seeing people make a choice if they have an offer between which major financial city do they want to take, taking Singapore over Hong Kong? We're seeing a little bit of that as well, yeah, in its early stages.
How far is Singapore from Hong Kong? I don't mean miles or distance, but how mentally attached on the Pacific Rim, how linked is Singapore to Hong Kong?
Well, you know, it's a 3-hour flight, and there are some connections, but this is a place that operates a little bit differently. You know, the analysis that a lot of expats landing here will say is that it's sort of a Switzerland of Asia, whereas Hong Kong is very much an entrance point to China. Singapore might be a Switzerland between USA, China, and also an entrance point to Southeast Asia. So while they do think of things a little bit similarly in terms of business regulation and access to capital and things like that, they are kind of positioned differently, and certainly since this national security law has put forward, they have been positioned, I think, very differently. Certainly in the minds of investors in terms of, you know, outside China investors, your Australians, your Americans, your Brits, et cetera. The opinion of them has gone from being two very similar things, albeit different in scale, to two very different things. And it's going to be interesting to see how that manifests over the next year, to see if some of those initial nibbles become full-on bites and changes in strategy.
Derek, thank you so much. Derek Waldbank in Singapore today on this uproar over TikTok and a few other issues there as well. Futures at -9, Dow futures at -38. On the politics of the moment, on a Washington frozen in the heat of August, balance of power, Braun of Indiana in the 12 o'clock hour. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Bloomberg Surveillance, I'm Ritika Gupta. Let's get the Bloomberg Business Flash. BP has cut its dividend for the first time in a decade. That removes a cornerstone of its investment case after the coronavirus pandemic hammered almost every part of its energy business. BP reported an adjusted net loss of $6.7 billion in the second quarter. The company smashed its dividend in half. It's another setback for a company that has struggled to protect private user data. The Federal Trade Commission is investigating Twitter for alleged privacy violations. The issue, whether Twitter used phone numbers uploaded for security purposes to target people with advertising. In a filing, Twitter says the probe could lead to a loss of up to $250 million. And that's your Bloomberg Business Flash. Francine, Tom?
Ritika, thanks so much. I really want to point out the disinflation that is out there in the data screen, and I want to go right to the 10-year tips in America, breaking under 1%, negative 1%, I should say, a few days ago. Now it is a negative 1.04. That is an extraordinary negative real yield in America. Of course, all of this heading for the jobs report Friday. Francine?
Yeah, Tom, and negotiations, of course, on stimulus have become increasingly urgent with millions of jobless Americans left without any additional aid. European stocks are down. Now, coming up, we speak with Scott Thiel, BlackRock Investment Institute Chief Fixed-Term Strategist. This is Bloomberg.
The decision came pretty quickly over the last 4 months. Once the lockdown happened, we decided we no longer wanted to be in an apartment building and we wanted to have a little bit more room for our family.
I think the pandemic really caused the glue to hold the commitment we had to Manhattan to fall away, because since the banking and the technology companies have said to their people work from home, there's no need for us to be there to service the mass population.
Right.
So if everyone's working from home, we will too.
Restaurants, bars, New York City nightlife, Yankee Stadium, everything about the city. We still love the city, but with the way things are going right now, like I said, I think it's a good move for us and our family.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. Let's get right to it. Futures at -9. This is, without question, for Global Wall Street, my fixed income interview of the day. Mr. Thiel is at BlackRock, of course, giving us a long-term perspective on the fixed income world, the fundamentals of the fixed income world. Scott Thiel, good morning. I want to go right to the 10-year tips and to the disinflation that is indicated by it. When you see a negative 1.04 in the 10-year tips, what does that indicate?
Well, I think there's a couple of things there. One, Tom, obviously, is that the break even, so the spread between the nominal rate and the inflation-protected bond has actually risen quite a lot since the crisis, and in fact has retraced 100% of the collapse in inflation expectations that we saw. And so, yes, tip rates are negative in yield, but the spread or the expected inflation protection is around 1.5%, up from about 1%. So despite the rate being negative, the real rate being negative, the actual break-even inflation, so expected inflation in the next 10 years, has actually risen to 1.5%. And that's oil prices, that's economic recovery, that's activity restart. That's all the things that have brought, asset prices higher.
Okay, I know with history at Princeton, you have to take 4 years of calculus. That's one of the charms of Princeton. Let's do the partial differentials right now. Which gives in? Do we see the nominal move either up or down, or does the real rate adjust? Which is the greater mover in the next number of months?
Well, it's a great question. And so what we focus on, you have the 10-year Treasury up there, but obviously that has been, the volatility of that has been very, very low. What's been more volatile has been 30-year rates. And so as we kind of approach what we think are the bottom end of 30-year rates, we take a little bit more of a negative view on interest rates going forward, suggesting 30-year rates to be in a range of kind of 150 to 115. So we're closer to the bottom end of that range. So I would say that, yields have this opportunity to move higher, obviously dependent on activity restart. And as you were talking about before this segment of the show, the presidential election, geopolitics, et cetera.
Scott, what happens to inflation 12 months down the line?
Well, I mean, clearly the activity restart is going to be critical. Energy prices, which are very tied to that, is going to be important. There's going to be obviously a period where the economy has suffered dramatically from the COVID crisis. But we would note that on balance, although recently some of the activity numbers, the high frequency numbers have come off, still there has been a relatively strong rebound, obviously, in economic activity. Interestingly, with Europe apparently leading the way versus the United States. So you'd have to expect that over time, as the economy retraces the loss, primarily, as a result of much of the stimulus coming through, we expect the U.S. economy to kind of be back to trend growth kind of in the third to fourth quarter of 2021. That if that's the case and there isn't a, huge impact of additional virus outbreaks, that we get, that inflation begins to move higher. We've been positive on tips, positive on inflation break-evens because of activity, economic activity, but also because the stimulus itself obviously is inflationary over a longer term.
So, Scott, overall, if you look at, the composition, for example, of the U.S. economy, where do you expect the longest-term scarring to happen?
Well, I mean, I think it's, it's going to be obviously the number of the sectors that have been dramatically impacted by the shifts in activity and obviously the shift in investor and consumer activity. And so, when we look at the equity market, we continue to like things like the quality factor because we see the companies in that bucket performing well given their position and given their their cash flow and the dynamics. I think obviously some of the other companies that are more involved in the sectors that have been beaten down, it's not just about being beaten down in this environment, it's also how do consumer preferences evolve over time. In other words, do consumer preferences shift? So is it safe to travel? That's one thing. Do people still want to travel? Obviously, after the initial surge is another thing.
Scott, I want to rip up the script here, and I want to be delicate here because I know at BlackRock it's not the charm to go out and badmouth other banks, but we had a number of banks in the derivative space blown up recently over quote-unquote structured products. Folks, this is where you get a bond-like equivalent, almost guarantee on where you are, and you put some optionality on top of it to do better. Once again, Scott Teal, with the pandemic, with the lack of payment of dividends by corporations, these so-called structured products have blown up. Is it a productive business for Wall Street to do structured products, or is it just a gimmick?
Well, I mean, I think, implicit in a structured product return is this idea of selling volatility, right, Tom? So that's, as you described, basically what you're doing with a structured note is you're effectively taking the view that the volatility, obviously there are different types of structured products, but the one I think that you're talking about here is effectively taking a view that volatility is not likely to increase.
Yeah.
So in periods of economic calm, in periods of policy calm, you can benefit, and we saw that in the 2005, 2006 run-up, and we saw that even if you go back further, the whole savings and loan crisis going into that was also a period where a structured product was very favorable to investors as a way of selling volatility. And so when you get to a period where particularly you have, the crisis that we've been in, which is, obviously the volatility extraordinary, they're not going to perform well, and you're going to suffer. So it's more about the product itself is a function of investors selling vol, and structured product is a way to do that. Yeah.
Well, with your heritage at Goldman Sachs and at BlackRock, are the good times of structured product worth it, given that when you get vol, you're going to blow up? Is it worth it for the good years if in 1 year you blow up?
Well, I mean, I think that, again, I think the premise behind these products is designed so that, and I'm not, I'm not taking a view on whether they're kind of a good thing or a bad thing, because that would obviously depend on the investors themselves and their parameters and their risk tolerance, et cetera. But on balance, they're not put together in a way that is designed to only last for a very short period of time and then to suffer, right? So there are views around volatility over the longer term. Obviously, Tom, they can obviously underperform and they can outperform. But again, I'm not in a position to note the kind of the sinister nature of the product. Just that it is designed specifically as a vol sale, and so they work brilliantly in periods of low volatility. And again, we've had long periods of low volatility in the past. They just don't work in periods when volatility
Beautifully explained. Beautifully explained. Francine?
Scott, thanks so much. Scott Thiel there of BlackRock Investment Institute stays with us. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Thanks, Francine. President Trump is turning up the heat on congressional negotiators. He says he may take executive action to stop evictions and to enact a payroll tax holiday. Republicans and Democrats say they have made some progress in negotiations on a new stimulus package, but they're still far apart on key issues. China's next target in the growing tensions with the U.S. could be American journalists in Hong Kong. That's according to the editor-in-chief of China's Global Times, who's become known for accurately predicting Beijing's actions. He says that if Chinese journalists are forced to leave the U.S., China will retaliate against American reporters in Hong Kong. Here in New York, Facebook has signed a lease for all of the office space at the Farley Building. That's a former post office on Manhattan's West Wide that's being redeveloped by Vornado Realty Trust. Facebook will take over 730,000 square feet at the site. It's located next to Penn Station Railroad Hub. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thank you so much. Now, coming up in the next hour, Carla Harris, Morgan Stanley Vice Chairman of Global Wealth Management. That's an interesting conversation on diversity and the way forward. That's at 6:30 a.m. in New York, 11:30 a.m. in London, and this is Bloomberg.
Boston, Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Bloomberg surveillance from New York, from London, a really interesting day. And of course, we are focused on Thursday jobless claims and then on to the, without question in my career, folks, the greatest mysterious Friday jobs report ever. It is going to be something to see what that math is given this horrific pandemic that we are in. Our Michael McKee yesterday with a smart conversation with Mr. Kaplan from Dallas. Let's listen.
It's still our view that we'll contract for the year at about 4.5% to 5%. It has been our view after a very sharp decline in the second quarter. We'd have very healthy rebound in the third and the fourth quarter. I think that rebound is more muted in the United States now. It's caused me to think that the unemployment rate, if we don't do a better job managing the virus, the unemployment rate is likely to be above 9%, between 9 and 10%. So we've moved up our unemployment forecast. So I think we've got a rebound, but it's much more muted than it was. And if we don't do a better job managing the virus, we're going to have lower growth and we're going to have a higher unemployment rate. And so I've been spending a lot of my time talking more about the virus than anything else because it's so critical to the recovery.
Well, the $600 extra unemployment bonus and eviction moratorium, they're gone now. First, has your staff modeled the impact of that on the economy? And second, should we expect a wave of defaults that might affect credit markets?
We have looked at it. And one of the things that's unusual about this downturn that we've just had is incomes have stayed relatively solid, and a big part of the reason is these unemployment benefits. And so we're normally in a downturn, you see a drop in incomes. We haven't seen that here. It's still my view that in some form we'll get an extension of unemployment benefits. So I'm quite hopeful that that will continue, but if it didn't, yeah, you would see a further weakening in the economy, and in particular because consumers wouldn't have as much money in their pocket to spend.
Any business people telling you that $600 bonus was keeping people from coming back to the labor force?
A lot of business people were telling me that, honestly. They were telling me that it was challenging to hire people. We've looked at a number of studies. We've done our own work. We don't see it as much in the data, but I can tell you I'm hearing it from business people. And so whatever the right answer is, I think you still are going to need to see extension of unemployment. It may be restructured to some extent from the $600, but I think it's important that we see an extension of it. And I think the increased incomes, while it may have made it hard for certain individual businesses to hire, it's helped create jobs because it's helped bolster consumer spending. So the net effect still has probably been positive for the economy and for employment.
Well, that was the Dallas Fed President Robert Kaplan with Bloomberg's Michael McKee. Now, still with us is Scott Thiel, BlackRock Investment Institute Chief Fixed Income Strategist. Scott, I actually want to ask about gold and where you see gold headed.
Yeah, Francine, just one comment on what was just said in the piece before, because I think it's very important to note that when we look at personal income increases over the second quarter, it was up 45%, the single largest increase ever in personal income. If there hadn't been government support, that number would have been down 22%. So I think what the Fed president just said, I think is very critical in that government support is a really important part of income and of keeping the economy back on track, just as a sidebar, because I thought that was interesting what he said, and the numbers obviously will back what he says. Yeah.
So, Scott, actually, given the stimulus and that we're still, in the midst of negotiations with all parties in the U.S., what is the one or two priorities that you think needs to be in there?
Well, I mean, I think it's, the Fed has expanded, has pushed back the policy cliff, right, by continuing to deliver the measures they have. So I think it's obviously very important that the government also gets by and continues to, in many respects, this concept of going direct, which is this policy revolution that is putting money into consumers' pockets, it's giving them direct benefits, is going to be very, very critical in keeping the economy going. Witness those disposable income numbers. So, Francine, I think it's about the policy revolution of going direct that needs, in our minds, to continue.
Scott Taylor, I want to get back to what Kaplan said and the ramifications here of the tool that they're going to use. Let's assume it's yield curve control. I'm really interested in how you feel the efficacy of yield curve control will be, not only out the curve, but the collar that they will have available. How big will that collar be, that range that they can really affect the true yield given market forces?
Well, I think it's a great question. So let's just look at the statistics now. So we're around 50, 60 basis points in 10-year yields at the moment, right? And the conventional view is that around 1% the Fed would implement yield curve control. We were there, at the beginning of the summer, right?
Yeah.
10-year yields got to around 95 basis points. That's a big move from where we are now, right? And given that the index has a duration of around 7 years, you could lose 3.5%, 4% in your fixed income portfolio if yields were to back up to 1%. That being said, I think it's an incredibly important tool, and obviously one that we look to see more information around in September. But it can really, Tom, it can really dampen volatility, out the long end of the market. Look what's happened to 30-year Treasury rates in this period where, although not explicit, clearly the Fed is moving towards a yield curve control framework. Not now, because obviously rates are so low, but if rates should move higher, or if their view around where rates should be would change, right? That's very important, because the whole point around yield curve control is to keep monetary conditions easy as stimulus is delivered, right? That's the whole point. So you don't want higher rates detracting from both policy easing and fiscal spending, right? So that's the critical part. And if that actually works out well, then you obviously are very positive for volatility going down.
We got to do this again. I got about 8 more questions there. Scott Teal, just brilliant today with BlackRock, not only on the potential of what the Fed will do in the fixed income space, but his important comments there on structured products as well. He's with the BlackRock Investment Institute. Coming up on Bloomberg, Marcus, John Tuttle. He is the New York Stock Exchange Vice Chairman and Chief Commercial Officer. In the 3 o'clock hour today. Stay with us with futures at -8. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Rishika Gupta. Let's get the Bloomberg Business Flash. Virgin Galactic is planning a $460 million share sale, and it will delay plans to carry founder Richard Branson into space until early next year. That's a milestone flight seen as the beginning of the company's tourism business. Virgin Galactic now says that Branson's trip will occur in the first quarter of 2021. Southwest Airlines has scaled back its aircraft cleaning operations. It's no longer wiping down armrests and seatbelts after every flight, as well as other areas around seats. The move is designed to keep planes from being on the ground longer than scheduled. Passengers can ask for sanitizing wipes if they want to do the cleaning themselves. And regulators are looking into a small group of investors who got rich when the price of oil took an unprecedented drop. It happened on April 20th when oil settled at minus $37. It was the first time crude had ever crossed into negative territory. Bloomberg's learned that traders at a tiny firm called Vega Capital London made as much as $500 million that day. Regulators in the UK and the US are trying to see if any rules were broken. And that's your Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. Now, staying on that $500 million jackpot, let's speak to Bloomberg's Liam Vaughan, who also co-authored the story. He's also a newly minted author of a book called Flash Crash. Liam, first of all, who are Vega Capital London, and how exactly did they make so much money? I mean, it's a couple of traders on top of a pub.
I mean, that's pretty much about right. Vega Capital London is a prop firm that's essentially an umbrella firm for maybe a couple of dozen traders at most. They've got an office above a pub near Liverpool Street Station. They were formed in 2016, and to be honest, nobody's really heard of the firm at all. Most of the traders are kind of slightly grizzled veterans of the market that have been trading since the days of the pits. And it looks like, after hanging in there with the arrival of automation in the market, these guys have finally had, hit sort of pay dirt. But unfortunately for them, their trading that day has also attracted the attention of the regulators. I mean, as you recall, markets fell that afternoon of April the 20th to minus $37. Vega entered a trade in such a way that it was allowed to buy oil for minus 37, so it was essentially paid to buy oil, and it also sold oil that day. So they got paid on both sides of the trade. It was a kind of completely unprecedented thing, almost like a freak occurrence, and they ended up walking away with, a very much a life-changing amount of money.
I mean, Liam, it's a 4.4 standard deviation on oil that day. I get that. And that's off the Bloomberg terminal. Fine. That's a very much equivalent to August of 2007. Somebody's got to make money in the market when you see these big moves. What's wrong with making money?
It's a good question, Tom, and, I will let the regulators kind of, go through this with a fine-tooth comb and come up with their own conclusions. I mean, there are specific rules around how you trade at settlement periods, and specifically, there's an offence called banging the close, which involves trading in such a way as to try and influence the settlement in order to get paid on another market. And that's, the kind of thing that has previously attracted problems in the past to traders that are trading this facility called trading at settlement. But you're absolutely right. I mean, nobody could have predicted that the market was going to go as far as it did. And, if you timed it right, then then you would have made a huge ton of money. So
Now, Liam, congratulations. It's a really thoughtful article. We got to leave it there, but really, really thoughtful article all in all. Just extremely well done. See that out on Bloomberg, folks. This is about that day where we saw negative $37. And, of course, we as surveillance know this because Lisa Bramowitz was on top of this trade and ended up with two 55-gallon oil drums in her living room, which is really worked out for the interior design. It's part of Bloomberg Business Week, this article. Look for Liam Vaughn and his team's good work there. And, of course, Liam, author of The Flash Crash, a trading savant, a global manhunt, and the most mysterious market crash in history. Coming up, must watch if you're in the equity market, Christopher Verone on the trends of the market with Strategas. Futures at -8, Dow futures at -27, the VIX 24.18, the NASDAQ 100 futures negative. This is Bloomberg.
see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The volatility in the first two quarters were quite exceptional this year.
Part of it is participating in the better market opportunities that have existed in the second quarter, and we do expect a normalization of that.
The situation out there is still very challenging and very difficult to predict, so we should never be complacent.
This morning, if it's Tuesday, it must be in Washington without a plan for 30 million unemployed. Still, the elite, they will meet to greet. The president, he goes after, quote, crazy Nancy, as well as a senator from New York who is helping, quote, radical left governors. Focus, it is August 4th, and do you know where the real yield is? The 10-year tips, it continues to deflate. All await the mystery of the Friday jobs report. And let's make a deal. The President of the United States wants some form of TikTok and Microsoft to write a check for, quote, key money, or they pay something, unquote. All of this to the Treasury of the United States. In Beijing, there's a discussion of, quote, theft. Good morning, everyone. What an odd Bloomberg surveillance. Tom Keene in New York, Francine Lacroix in Washington. The news flow, folks, right now is absolutely extraordinary. Francine, I can just say it's a continuation of the bizarreness of last week, all going up to the jobs report and now centered around this extended story of TikTok.
Yeah, so, I mean, yesterday there were certainly a couple of people asking exactly what the president meant. He almost seems to suggest that it was a finder's fee, that if Microsoft or someone else bought TikTok, then, you know, the U.S. administration somehow got a chunk of that for actually putting them together. I mean, this has never happened before. I'm not sure how that will be interpreted by insiders, but I know we're trying to find out whether he could do that. But it just goes to the heart of, you know, the relationship of this administration with certain specific tech companies, especially the Asian ones.
Yeah, there's no question about that. And I really should point out, folks, that one of the key things here overnight, while you were sleeping in America and frankly in Europe as well, the basic idea is the Chinese really have pushed back aggressively. We'll have much more on that. Speaking of that, tonight, our Emily Chang in conversation with Mr. Gates. You're going to see this across Bloomberg Asia TV. This is an exceptionally important conversation on his Microsoft and this new idea of going after Minecraft, going after TikTok potentially, and of course the new ideas that we've seen from the new leadership at a very, very successful Microsoft. Bill Gates tonight and throughout the evening on Bloomberg Asia TV, that with Emily Chang. With our first word news in New York City, here's Ritika Gupta.
Morning, Tom, Francine. President Trump may take executive action if Congress can't agree on a new coronavirus stimulus package. The president told reporters he might impose a moratorium on evictions and enact a payroll tax holiday. The White House is also exploring whether the president can act on his own to extend enhanced unemployment insurance payments. President Trump insists that if TikTok's U.S. operations are sold, the U.S. government should get a cut. But it's not clear under what authority the president could extract a payout. He said the money would come from China or from an American buyer such as Microsoft. Earlier in the day, the president said TikTok would have to close in the U.S. by September 15th unless an American company buys it. Hurricane Isaias was downgraded to a tropical storm as it made a landfall and moved inland over North Carolina. It's prompted tropical storm warnings all the way to Maine, including Manhattan. Temporary flood barriers and platforms have been deployed in New York City. The storm doesn't pose a threat to any major oil refineries or platforms. And Northern Ireland faces a Brexit food time bomb. Extra paperwork will raise British supermarkets' cost of operating there so much that some may pull out. That's according to the Northern Ireland Retail Consortium. Starting January the 1st, animal products transported from the rest of Britain to Northern Ireland will require export certificates. That could add $52,000 to the cost of each shipment. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
All right, Ritika, thanks so much. A -9 on futures, slight deterioration there, but major deterioration in the last 20 minutes in yields. A lower yield, higher prices there on notes and bonds as well. 10-year yield 0.5363 to 4 digits. That's in a solid 2 basis points. A 121 on the 30-year bond. As I mentioned earlier, that great conversation with Scott Teal that we had with BlackRock, really, really important for global Wall Street. The 10-year inflation adjusted -1.05. That is a stunning statistic under any discussion, Francine.
Yeah, Tom, so I'm actually looking at a very similar data check to yours. I'm also looking in Europe in general at stocks losing steam, futures also losing steam. I think there will be a lot of focus on this possible fresh fiscal stimulus from the U.S. to see whether it gets approval. Yeah. And, negotiations have become increasingly urgent with so many Americans left out with additional aid, and that's starting to weigh in on the markets. The other story is a story with Argentina. Now, unclear exactly whether there is a deal or whether there's just a postponement, but it seems that we have made our way onto something, and there's a bit of optimism out there, and you can see actually the Argentinian peso at 72.5150.
Very good. Right now, our chief Washington correspondent, Kevin Cirilli, with us. Before that, we want to show how the discussion changes in Washington. Here, the President of the United States.
The United States should get a very large percentage of that price because we're making it possible. Without us, you know, I use the expression, it's like the landlord and the tenant. And without the lease, the tenant doesn't have the value. Well, we're sort of, in a certain way, the lease. We make it possible to have this great success.
Kevin Cirilli, our chief Washington correspondent. Kevin, it's like a Tim O'Brien question. Of course, his great book, The Art of the Deal, and how Mr. O'Brien knows all of the finances and the ways of Mr. Trump as well. This guy never left the real estate business, did he?
No. And in fact, I think that's what you're seeing applied to U.S.-China relations in many ways, and now being applied to Silicon Valley. And I think, you know, it will be incredibly interesting to see what Bill Gates tells Emily Chang later today as it relates to where Microsoft is headed, because the president has said, and Microsoft has said, that by mid-September, this will be finished. And I said yesterday, and I'll say it again, in conversations, Tom, with members in both parties on Capitol Hill, they're looking at this as a potential policy playbook that could outlast the Trump administration and could be utilized for quite some time. And also around the time of mid-September, and this is where it gets even more interesting, is that bipartisan group of lawmakers, the working group of lawmakers who are working on U.S.-China policy, are set to unveil recommendations on a host of different U.S.-China policies.
Well said. There's a game theory here, and that is, I think I'm Stavridis or, you know, whoever on international relations. The Chinese will respond, and we saw that from Carl Lenin overnight with Bloomberg, where they're calling it theft, they're calling it some really tough language. Do any of these people in Washington actually understand the Chinese may respond?
I don't think they care.
Yeah, I agree. Thank you. You have to say it. Yeah. I can't. Kevin, here's the rules. I can't say that. You have to say it for me. Okay, they don't. Kevin, they don't care. I get it. But that's not good enough into 2021, is it?
Well, I don't think they care, because when I talk to them, they're looking at, you know, all of the different investments that are available around the world. And at the end of the day, I mean, the U.S. has had several successful apps. I mean, just look on your smartphone from Facebook, Instagram. I mean, the list goes on. We could check them off. But I say they don't care in the sense that they're looking at India. They're looking at other investments. They're looking at Israel, which, of course, is a prominent tech sector as well. And at the end of the day, tough talk is tough talk. But for the President of the United States, based upon my reporting, to say several weeks ago that he's really no longer interested in that U.S.-China Phase 1 deal, we're not dealing with the U.S.-China relations of pre-COVID-19, which were tense to say the least. We're in a new reality, and the intelligence committees on Capitol Hill in both parties understand that.
Kevin, in the new reality, is everyone blaming it on President Trump, the fact that they can't find a stimulus and that still people are dying, or can he turn the polls going into November?
With regards to the stimulus, Francine, the president yesterday saying that he could utilize executive order and executive action to go around Congress and the impasse that still very much has dogged this town here. But I will say that from a strategic standpoint, the president saying that he could utilize executive order recognizes that this could be a much more prolonged impasse than perhaps had been many lawmakers have been aware. So for Speaker Pelosi, who came out yesterday afternoon and reading between the lines, said that she had an optimistic meeting, but still work needed to be done, but that they did make headway in her meeting with Secretary Mnuchin and Mark Meadows, the president's chief of staff. There seemed to be a positive interaction yesterday, this coupled with the dynamic of the president saying, keep working, because if you don't, I'm going to use executive order.
What is the one thing, Kevin, that people are saying when it comes to TikTok and other things like that? I mean, does it actually, play out also in November, some of the things that we've never heard before, or do people kind of just, take it in their stride?
China is definitely going to be an issue in this campaign. Last week, I spoke with former President Obama's Deputy Secretary of State, Tony Blinken, who is the presumptive Democratic presidential nominee's top foreign policy advisor. He said that the Biden campaign and the presumptive nominee are going to make the case that strengthening Western alliances is going to better the U.S. in a position to deal with Xi Jinping.
Kevin, is there any history where Americans vote on foreign policy / China? Is there any history where it really matters the first Tuesday of November?
I think that if you go back to World War II and whatnot, but even that during the First World War and the Second World War, Tom, largely were economic components. Here's where China matters from a populist, American populist perspective, is that the populist streak in American politics on the left and on the right, there is that skepticism of China stealing U.S. worker jobs. And I think to that point, that plays well in Scranton, Pennsylvania. And I think that's why you're seeing the president argue that he would be tougher on China than Joe Biden.
Great report, Kevin, particularly there on this movable feast known as TikTok. Mr. Cirilli is our chief Washington correspondent. We've got much more coming up, and this is timely as well. Talk about on key money. The key Commerce Secretary, the former Commerce Secretary, the gentle lady from Chicago, Penny Pritzker, in the 5 p.m. hour. Stay with us. This is Bloomberg. Futures deteriorate, -11.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and business is depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. Futures deteriorate, -8, now -10. Well on our way to -11 on SPX. Dow futures, -50. And in yields, it sort of unravels over the last hour or so to a lower yield regime as well. Right now, the best gentleman I know on the street on the trend. Mr. Zweig used to say the trend is your friend, and Christopher Verone has taken that seriously at Strategas, where he helps Jason Trennert with charts, the trend, and the view of relative strength. Right now, we get stronger with Mr. Verone. Christopher Verone, real simple. I want to go to yield first before we look at the equity market. The 10-year yield speaks volume. On a log chart, there is convexity. There's an acceleration to a lower yield. Do you just assume that trend is in place until otherwise?
Yeah, I mean, I think you have to, and the trend has been in place here in lower bond yields realistically for the last 2 years, and that has not changed. Tom, I think the The more difficult question is what information is being communicated through lower bond yields right now? Is this such a repressed asset class that it's really not telling us much about the state of the economy or the state of the equity market? And I think that is the more important question that we need to ask.
Okay, it's a more important question we need to ask. That's fine, but the fact is there's different houses saying there's a long-term trend of disinflation here. Can you glean that effect, or is there so much noise around the Fed that you can't do conventional chart analysis on the full faith and credit space?
I think when you look at the trajectory of bond yields, they clearly point lower. What doesn't jive with that, though, is what we're seeing in a lot of other asset classes. A dollar lower, copper up, crude firm, gold strong, I think is suggestive of perhaps the world transitioning into a little bit of a less disinflationary environment than we've been accustomed to for the last couple of years. So there does seem to be a change at foot. It's just not the bond market that's reflecting it yet.
Chris, where do you see gold? What do you see gold doing from here?
I think in the very, very short term, let's say next 60 days, it's overbought enough to consolidate. And I think part of that call would suggest that the dollar's probably oversold enough where it can bounce. But if we're thinking about this structurally, next 1 year, next 2 years, next 3 years, gold is one of the best long-term charts we can find. It is a clear upturn. It is going up in every currency. So no matter how you own it, it's paying you. That is the definition of a bull market. Gold is a structural bull market.
But what will it take for that trajectory to change, Chris?
Well, listen, I think very, very tactically, when you look at flows into gold over the last couple months, they've gotten to the point where they're probably too aggressive in the short term. We've also seen gold right now, its deviation from a 200-day moving average is about as extended as we've seen in a number of years. So I think the short-term trajectory is one that can be questioned here. I don't think this is the appropriate. I don't think this is the appropriate moment for fresh longs here. But if you're thinking about the longer term story here, it's still very much intact. Negative real rates, I think, supports this. And I think ultimately the debasement of currency around the world supports this call as well.
Christopher, on one equity question, I'll have you come back on the stock market right now. We've seen a jump condition in the glory NASDAQ stocks, Apple, Amazon, all the rest of them as well. Do they close the gap and pull back, or do they sustain here and work higher?
I don't think anyone's going to look right here for the next 60 days or so. We're in a tough seasonal stretch. We have an election, as we know, in front of us in 90 days. I think the market's going to chop here as we move through what is this weak seasonal stretch. So I think, Tom, to answer your question, I would not be surprised to see some of these come in over the next number of weeks. But I don't want to lose sight of the bigger picture. And I think the bigger picture remains, and we've talked about this with you in the past, we think March was a major, major low. We had a momentum surge coming off the March lows. I think we're just consolidating that move right now. I would fight the temptation to get too bearish.
The NASDAQ futures at 11,000, an extraordinary statistic. Christopher Roan with us, and we will continue as well. I do again want to mention the yield space where we've seen 10-year, 30-year bond yields come in this morning. On the American economy, looking at claims on Thursday and this amazing jobs day on Friday, the mystery of it all. Francis Donald with Manulife. We do that in the 7 o'clock hour. This is Bloomberg. Good morning.
المستوى من تعقيم اليدين بالنسبة للحجاج، لبس الكمامة، التباعد المكاني، التوعية الصحية لهم في الباصات، وحتى وصولهم إلى الحجر المؤسسي بمكة المكرمة.
أنا لا أدري كيف أصف هذه المشاعر في قلبي. كما تعرفون أن هذا الركن من أركان الإسلام الحج، واختارنا الله سبحانه وتعالى أن نكون ضيوف الرحمن لهذا العام.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, we were having a good conversation about the markets with Christopher Verone. He's Stratega's partner and head of technical and macro strategist. So, Tom, let's go back to Chris. When you look at what's being priced in on the market, Chris, are markets, you know, they think this time is different. You were telling me that you don't think it is in terms of valuations or cycles.
Yeah.
How do you see the pandemic evolving?
You know, I think every crisis is certainly different and unique, but what typically is not different is the market's interpretation of all of these events. And I find it striking that while the sequence of events this time around has probably been accelerated order, and by that I mean markets tend to bottom before the economy gets better. I mean, just go back as recently as 2009, market bottoms March of 2009. You actually don't start seeing employment improvement until early 2010. So a full year spread between when the market bottomed and when employment started getting better. So to think that this divorce or divergence between the market and the economy this time around is anything special or anything different, I think is a mistake. Yet it seems to be kind of the widely held consensus view that this is so unique. I'm not convinced of that.
But, Chris, at the same time, you're going to have bankruptcies. And I don't know whether it's bankruptcies of companies that would have, you know, gone bankrupt in 2-3 years. Does it accelerate a trend? Does it make what we would have seen in the next 10 years happen in the next 2 years?
Yeah, I think in a lot of respects, it's almost like you pulled an entire recession forward. You know, if you look at this through the lens of some other metrics, I think it's important to remember that things like earnings tend to turn up about 6 months after the market's bottom. Things like revenue tends to turn up about 12 months after a market has bottomed. So I think we have some time here for those metrics to get better. And if you put this kind of in some broader context, this is where I think the positioning data is so helpful. You know, in the pursuit of excesses or looking for where excesses may be, I think it's important to note since the March 23rd market low, only about $20 billion into equity ETFs, about $120 billion into bond ETFs. So I would ask, where is the excess? It might not be in equities like many suspect that it is.
It's right where I wanted to go, Chris Verone, and this goes to the catharsis or the exuberance at hand. Can you measure catharsis or exuberance technically in a pandemic like you would in a normal economy?
Yeah, I think you can, and I think the charts do a very good job of telling us a story, and where we see flows that are so excessive or so dramatic tend to be in the lower volatile corners of the world, and that certainly is bonds. It's corporate credit as well, where the flows since March have been excessive. So I think those are the areas where if you're on the lookout for where the excesses may lie, those seem like more logical places than the equity market.
Very beneficial. Christopher Owen, thank you so much for Strategics. And again, we protect the copyright of all of our guests. You can get his wonderful technical research only through his company, Strategics. Speaking of copyright, Moffett Nathanson, everybody on the street wants it. Craig Moffett, Michael Nathanson. Michael Nathanson will stop by. Moffett's taken off the month of August, but Nathanson is hard at work on Disney. And also, we'll talk to Michael Nathanson about TikTok. He's on it like, I don't know, 9 hours a day or something. Nathanson, next. Futures -9. This is Bloomberg.
It's humbling, and it's incredibly exciting in terms of anything that we've done, so far as a company. Florence isn't trying to trick you that she's a real person. Florence is saying, I'm a digital person, I'm here to help. Florence is digital, there is no judgment involved. So the lack of human judgment actually makes our digital people more approachable and potentially more helpful.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you experts and subjects from public health to international affairs. Well, joining us now is Carla Freeman, Johns Hopkins Executive Director of Foreign Policy Institute and Associate Researcher Professor of China Studies. Professor, thank you for joining us. How's the relationship in terms of, sharing of vaccine information between the U.S. and China right now?
We are not doing well in that direction if you consider sharing important. The Chinese released the genetic sequence of the vaccine in early January, which proved really important to the jump-started so much research into a vaccine for the virus, but the U.S. and China relationship is at a nadir at this point, and there's very little communication between the two sides.
The Chinese economy, Professor Freeman, is actually growing quite rapidly after the pretty massive lockdown. Is there any lessons that we in the West can take from how they've done it, or do we just do it differently in the West?
Well, it's really the same across all countries. You have to do testing, you have to do contact tracing, and you have to isolate people, or you have to engage in social distancing. China used extreme measures from a Western perspective early on, literally shutting down an entire province. And since then, it has really enforced measures very strictly. But what has happened around the world is we've learned that even just wearing masks can significantly cut the rate of transmission. But it's very difficult to get people to do that in countries that have more